This show was produced by Martin & Co. and is for information purposes only.
Good morning, everybody. I'm delighted to welcome you to the 2026 Investment Companies Forum. So we've got a good lineup of managers for you to listen to. We're going to actually open with a wealth manager called Ben Conway, who some of you may know because he's been at the forefront of some of the campaigns that we've been doing with the sector to try and bring all the regulations, everything into line and get things a bit more supportive. So he's going to tell you exactly what we've achieved so far this year, which is, I think, has been a great step forward. And then we're going to run through some managers. So we've got 5 of those. We're going to punctuate that in the middle with the chat between Gavin and Jonathan Davis from Moneymakers. And we're going to kick off with Murray Income, Nick Shenton. So he's going to talk to you about that trust. They've been managing it at Artemis for about a year now, maybe a little bit more. And it's all about really how they see the UK equity market going forward and how they're positioning the fund for that and how they think performance is going to turn around. So let's listen to that and see what you think. Then we're going to go to Global Opportunities Trust and Alan Bartlett. And here we have a fund that's set up to be defensive. It's set up to preserve capital when markets get a bit wobbly, pays you a bit of an income. So he's going to explain his thinking about where the world is now and what he thinks is going to happen over the course of the next year or so and how the fund's positioned for that. So I think that's going to be an interesting one. And then we're going to go to Laura Foll from Law Debenture. So you've seen Law Debenture on the show a few months back, and then we had the chief executive talking to us. But Laura Foll is one of the managers on the equity income portfolio. So she's been telling us how that fund's going. And it's been one of the best performing of funds in that sector. So it'll be interesting to see how she's doing it. Then we've got that chat between Gavin and Jonathan, as I was talking about before. After that, we're going to Europe, to the Baillie Gifford European Fund, and we've got Joe Faraday talking about what he's doing with that trust. And obviously, that's had a bit of a win recently with this IPO of Bending Spoons, so you can probably fill us in on that. And then we're going to finish up with Prashant Kemkar talking about Ashoka, WhiteOak, and emerging markets. The emerging markets have been one of the places to be so far this year. There's a bit of a wobble around the Iran war, but he'll be telling us about how's his approach to running that fund and the way that they charge is a bit different to the way most funds charge. And so that's something that they'll probably bring out in that conversation. So plenty to talk about, plenty to listen to. Please do dive in and out. If you've got questions, some of you probably pre-submitted them. They'll be going in the chat box, but do add more questions in as they occur to you. Our analysts are going to be standing by to answer those as we go through the day. Do hope you find it useful, and I'll talk to you later. Bye-bye.
Hello there. My name is Ben Conway. I'm Head of Fund Management at Hawksmoor Investment Management. We are a fund manager and wealth manager, and across all of our mandates and portfolios, we have around $500 million or so in investment companies. And I'm here today to talk about my views on the sector and why I'm considerably more positive on the outlook for the sector today than I was a few years ago. I want to give you a bit of context for why that is. I want to do so with relation to the role that I've been playing along with many others, including most visibly the Baronesses, Baroness Bowles and Baroness Altman, in terms of pushing through some reforms in how investment companies are treated, which I'll talk to you about in a little bit of detail now. So why am I a lot more positive? Well, I can't be more positive without giving you the reasons why I was so negative a few years ago and why it was so important, I think, for me and a number of others to campaign for correct treatment. And that was that we were in a position for going back 4 or 5 years where there was the potential for investment companies to be mistreated in terms of how investment company costs, or the word I prefer to use the word expenses, were being disclosed, or more accurately, the way they were being aggregated in the portfolios of professional investors, or rather the portfolios of in fund of funds and in private wealth portfolios, the way that professionals were required to aggregate those costs and tell people what those costs were. And in brief, the erroneous treatment amounted to the fact that investment companies obviously do have costs. They have management costs and many other things, but they're subtracted from the net asset value rather than the share price. And what, for a period of time, what professional investors and indeed third-party platforms that were disclosing these things, these costs to retail investors, what they were being forced to tell you was that these costs, again, I really want to use the word expenses, but costs are a lot more ubiquitous. These costs were being presented as if they were being subtracted from your investment capital, i.e. the share price. And that ostensibly just isn't the case. So what over a number of years, we lobbied the Treasury, lobbied the FCA, along with many others. And in the end, we've got to a place today under the new what's called the CCI regime, Consumer Composite Investments. This is the regime that replaces some EU retained legislation, which a bit more jargon is called PRIPS. We've got the correct treatment in fund portfolios for investment companies. So if you run a fund of funds and you're telling your investors what the total cost of the portfolio is, if you own investment companies, you're not wrongly aggregating the investment company expenses in with the overall costs. And just at the end of last week, the FCA released their consultation on what's going to replace the MiFID regime. And the MiFID regime was EU retained legislation that governed what wealth managers, as opposed to funds, what wealth managers that own investment companies in their portfolios were telling people about the investment company costs. And we've got, in that consultation, got similar treatment. So as a result of all of this very unfortunate treatment a few years ago, and before we got these corrections in, what we saw was widespread selling by wealth managers and fund of funds, because it became commercially really terrible to own these investment companies, because by holding them, you were basically telling your underlying clients that their portfolios were more expensive than they were. And in a very competitive environment, that's a very bad thing to do. In addition to that, you've seen a wave of consolidation in the wealth management sector. The most obvious one is that between Rathbones and Investec. And these wealth managers are becoming bigger and bigger and demanding more and more liquidity from their underlying investments. And at a time where investment companies were becoming less liquid, then you saw, and at a time where wealth managers were just becoming bigger and bigger, you were seeing these wealth managers continue to exit from the sector. The cost pressures, consolidation pressures meant that discounts were really widening. And in response to that, we've seen activists coming to the sector. Because if you think about what happens in a free market, when you have discounts widening, you either need to see the supply side do the work, which is the number of investment companies shrink, or the demand side do the work, which is hopefully you attract new investors into the sector. And we saw an entirely rational response to discounts widening as a result of these largely technical factors. And that was the fact that you get activists coming along. And what we always say about activists is that they're entirely necessary and indeed healthy part of the ecosystem. But sadly, some of their tactics can be distasteful. Nonetheless, the analogy that we use is that they're rather akin to a wasp. You don't want a wasp. Nobody wants a wasp at their picnic, but without wasps in the ecosystem largely fails. And so over the past couple of years, as a result of activism, you've seen a lot more discipline exerted on the sector. You've seen boards react to their wide discounts with a lot more alacrity. So buybacks, mergers, etc. And so that has been the supply side doing the work. And you've seen discounts finally stop widening. On the positive side, and now let's turn to why I can being so positive, number one, as a result of the campaigning and lobbying on behalf of the campaigners and the AIC, we've got that correct treatment of costs. I think the selling from the wealth manager consolidation has certainly peaked. And lastly, there are tentative signs of a brand new source of demand for investment company shares. And that could potentially come from the pension fund sector. And another campaign led by especially the baronesses here was on the pension schemes bill. Now, you may be aware that there was quite a lot of furore around this and controversy around this pension schemes bill around mandation. And lots of people don't want pension funds to be mandated where they invest. And one of the things that the government was very keen to do was see pension funds help fund things like infrastructure projects in this country. What we saw prior to the pension schemes bill coming in was something called the Mansion House Accord, which was something that the pension funds voluntarily agreed to, which is to have at least 10% of their portfolios invested in less liquid assets, like infrastructure projects, of which half would be in the UK. The Pension Schemes Bill went a little bit further and said, if you don't hit that target by 2030, we can mandate you to do so just once. And buried in that was the fact that prior to the baronesses getting involved and securing a very, very crucial amendment, if pension funds were to invest in investment companies, into an infrastructure fund, for example, their investments in that would not count towards their minimum. Instead, they would achieve their minimums via investing either directly into the projects or more likely via evergreen funds and semi-liquid funds and something called the LTAF. So the fact that investment companies weren't included was a disaster, really. But as a result of the campaigning by the baronesses, an amendment was achieved, and now investment companies will be included. So now you have a situation where pension funds can invest in this wonderful sector. They can invest in investment companies that have been around for decades, that are investing in infrastructure projects, both in the UK and abroad, that are trading on wide discounts. And if you think about the value proposition, they could invest in an investment company that's trading at, say, a 10% discount, with a fully invested portfolio, with a little bit, and with using a little bit of leverage. Essentially, their pound of investment in investment companies buying them more than £1 of exposure to an infrastructure project or renewable energy project. If that same pound was invested in a semi-liquid fund or an LTAF, for example, those funds, because of their redemption and subscription rules, have to own a decent amount of cash, probably around 15%. So the pound which you invest in those semi-liquid funds at the value of the portfolio, that pound is only buying them around 8p of economic exposure to the infrastructure sector or renewable energy sector or whatever it is, and then the balance in cash. So the value proposition of investing in investment companies is absolutely fantastic. The big issue with investment companies twofold is, one is they're just not big enough yet and to really attract substantial sums of money from pension funds. And secondly, pension funds don't like that volatility of the share price. The advantage of those semi-liquid funds is that while they're only pricing potentially 2, 3, 4 times a year, they're just, in a mark-to-market sense, not as volatile. Nonetheless, I do think that there is the potential for pension funds to use investment companies alongside these sorts of funds. So, reasons for positivity: supply side's done the work over the past few years. Sadly, we've lost a number of investment companies, but also boards have been buying back shares with a lot more fervour. We have had activists come into the sector, which is in some cases been rather disappointing, some of the tactics they've used, but they have been a really disciplining force. And we've seen better capital allocation from boards. So we've seen an effective supply side response. And on the positive side, in terms of increased demand, there's going to be, I think the selling from the wealth managers and fund of funds has peaked, and in fact may even be returning again. Now we've got proper treatment of investment company costs, and there's a potential for really substantial demand from pension funds, particularly in the light of the amendments to the Pension Schemes Bill and the fact that we've got the Mansion House Accord. So discounts have started to narrow, and I very much hope that in just a few more years we see that at narrower level even from here.
The Murray Income Trust is managed by a team of experienced investors from Artemis, of whom I am one, Nick Shenton, and I co-manage the fund with Andy Marsh and Adrian Frost and Jamie Lindsay. We have a 25-year track record of delivering dividends, dividend growth and total returns in the UK market. We feel that we have a process which works in different market conditions, which lends itself very well to being in an investment trust structure. Volatility is relatively low versus the market and hence lends itself to a modest amount of gearing, which can enhance total returns. The trust is a dividend hero, and we have ambitions for it to be a total return hero as well. Hi everyone, my name is Nick Shenton. I'm a fund manager on the Artemis Income Strategy and a fund manager on the Murray Income Trust. I just have to show you the usual key risks and disclaimers. Please take a moment to read through. We were delighted to be invited to manage the Murray Income Trust earlier this year. in a way, we feel like it is finding a missing jigsaw piece for our strategy. We are long-term investors, and we felt that it was a very good fit to be running this type of vehicle. Now, the Murray Income Trust is dividend hero, which means that it has raised its dividend for over 20 years consecutively. We are very committed to retaining its status as a dividend hero. And we also have ambitions for the Murray Income Trust to become a total return hero. For us, the power of investing in the stock market is to generate dividends which grow over time. That protects wealth and it enhances wealth. And that's why we think it's such an attractive asset class, and why we think we have a process which creates value over time. We are intending to run the fund with a modest amount of gearing. And what does that mean? Well, it means that we will use some borrowing facilities to increase our overall investment. And over time, we expect that can enhance the total return characteristics of the portfolio. We also feel that the underlying nature of the type of investments we make lends themselves to a modest amount of gearing. And this is one of the aspects that attracted us to running an investment trust. Currently, the income trust trades at a discount to its net asset value. And what does that mean? Well, as of yesterday evening, you could pay 93 pence for assets which are worth £1. In other words, the value of the shares of the Murray Income Trust trades below the value of the assets held by the company. We see that as an attractive opportunity, or at least a margin of safety. Fees are charged on whichever is lower, the market cap or this net asset value, which we think aligns interests with owners of the trust. We took ownership in March and completed a full transition of the portfolio from what we inherited to what we would prefer to be invested in within 1 month. So by the beginning of April, the portfolio was as we felt it should be, looking out into the future. Now, this is the long-term performance of the Artemis Income Fund going back to 2000. It is not the Murray Income Trust, but what we say about our approach on this is it is the same people, the same process, and the same portfolio, but just delivered in a different structure, which we think is, as I've mentioned, highly attractive as an opportunity set. We're not proposing to do anything which is out of the bounds of what we have done historically. We have strong belief in our process, and we think that it can be expressed in a very attractive manner in the structure that Murray offers. Over the long run, you can see very significant compounding of wealth from investing in the Artemis Income Fund. This is performance over the long run as well, again, for the Artemis Income Fund, and not for Murray. And these are the people who are running the trust. There are 3 fund managers, 1 analyst, and an investment director. Fundamentally, we believe investing is a team sport. Why is it a team sport? Well, by working with close colleagues, we think that we can enhance one another's decision-making and ultimately performance and wealth creation. It's absolutely critical that the team shares a philosophy, and we do. We have a very clear philosophy. It's best expressed as cash flow first, dividends second. Now, what does that mean? Well, cash flow to us is the true arbiter of how successful a business is. Is it generating cash? That's after everyone else has been paid. Accounting profits can be tweaked and pushed and pulled to deliver a result which is more favorable. Cash tells the truth, and that's why we focus on it. And the second reason is that dividends are paid out of cash. There's only a dividend available for owners of the business after everybody else has been paid. That is suppliers, that is employees, that is the government, that is lenders, and the business itself. We want to invest in companies that are reinvesting in themselves. That means that also that we are agnostic about what type of companies we invest in. Sometimes there are faster growing companies which are more attractive investment opportunities. Sometimes there are slower growing companies where the outlook is not as bad as people fear. Those can represent the best opportunities. We go where we see opportunity, and we take a genuinely long-term approach. In a matter of days, weeks, months, quarters, even years, then emotion and human nature have a really big bearing on how share prices perform. It's, as they say, it's more of a voting machine in that shorter term. We're looking for the weighing machine, and that is long-term cash flow and dividend progression. That's what really drives share prices, and that's where we focus. To highlight the experience of the team as well, I have 23 years professional experience of investing. That's a lot of time to learn from your mistakes, I would say. Andy has been investing for close to 30, and Adrian well over 40 years. Jamie is at the newer end, which is great because he is bringing different perspectives, different ways of doing things, and challenging our thinking. This is how we go about picking stocks. What's the key point here? Again, highlighted cash flow first, dividend second. What we're looking for from all of this is a consistent way of looking at companies, which is more logical than emotional, and hence makes different investments comparable. And we're trying to find a differentiated insight. That's the key to all of this. What do we see that is underappreciated in the share price? We go about that by looking at the industry structure and a value chain. So who's creating value and who is capturing that value? Are companies taking a fair share of the economic value creation? When business is done well, it's win-win. That's how standards of living rise. Companies must create more value than they extract, in our view. We think that management are very, very important for the long-term prospects of a company, because they're really setting the tone on culture, strategy, and execution. We spend a lot of time with a lot of management teams really trying to understand what makes them tick and where they have an edge. Then we build our forecast for cash flow, looking out 3 to 5 years. And then finally, we compare what is discounted in the share price to what we think is achievable. And when there's a big mismatch, often there's opportunity. Pattern recognition is really important to us. That's where the experience comes into play. The key is knowing which parts of your experience is relevant and which bits you need to forget. Now, on to the characteristics and performance of the portfolio. Well, the first thing to say is that we invest on a blank sheet of paper. We're trying to find the best investments. We're not looking at how the comparative benchmark, the UK stock market, is positioned particularly, which leads us to some really interesting places, we think. Some names on there you may recognize. You may even expect to see an Imperial Brands or a Lloyd's or an Aviva in a top 10 shares in a portfolio. You may not expect to see IG Group or Segro or Informa or Pearson. We're perfectly happy with that because these are businesses where we think the risk reward is very attractive. In the middle, you can see that our exposure to the biggest stocks in the market is lower than the benchmark. We see more value elsewhere outside of those larger stocks. And you can see that the return on capital, which is the returns that a business can generate from it, investing, are higher for the fund than they are for the top 20 of the FTSE All-Share. Now, here's some information on valuation. The fund or the trust trades at around 12 times earnings, which means in 12 years' time, if earnings continue at this rate, you'll have made all your money back. We think that's pretty attractive. It's cheaper than the benchmark, and it also stands out as being quite significantly cheaper than most other stock markets in the world. The debt is ever so slightly higher than the benchmark, but the dividend yield is significantly higher than the benchmark. That's what we're really interested in, the cash flow that drives the dividend. And in addition, there is a share buyback yield. The majority of the companies held in the trust are buying back shares and growing the dividends further from that. Now, this slide gives you some idea of how the trust has been altered since we became managers of it. The valuation you can see on the left, going back to this P ratio, is reasonably low at 12 times versus close to 15, which we see as a good thing to have a cheaper portfolio in general, without compromising on the caliber of assets driving that. And also notably, the dividend yield is reasonably higher at 4.1% versus 3.8%. And show some activity of how we're thinking and where we're seeing opportunity currently. This pertains to the Artemis Income Fund, but you will see that, as I say, they are essentially the same portfolios of investments. The same changes have been made in Murray. To highlight a couple of points which may stand out, we have not owned what we call consumer staples, businesses like Reckitt, who make Nurofen, and Diageo, who own Guinness, possibly the world's best beer brand, and a portfolio of spirits brands. Now, we've not owned those shares for the best part of 10 years. We've recently been buying. Why? Diageo, we've watched for some time. We know the new CEO very well through successful partnership in investing in Tesco. We think he's high caliber. He diagnoses problems. He is a problem solver, and he is a leader of people. People like he creates followership. We think he will diagnose what's been going wrong at Diageo, and people will follow him in fixing it. Both Diageo and Reckitt trade at their lowest valuations in about 20 years, which we find really quite intriguing. In terms of the ads, a couple of notes that may be of interest. Rosebank is really quite a unique business. It's in some ways a private equity business that happens to be listed. And we see tremendous opportunity for them. We know the management team very well, going back 15 to 20 years. This is a new vehicle for them. They have spotted an opportunity. The opportunity is that there are a number of assets, businesses held in the private equity industry, which have ended up in a bit of a cul-de-sac. They have perhaps not been run quite as well as they might have been, and they have too much debt. And now they're just being run not for stakeholders like the customers. They're being run for the lenders because they are being run solely to finance their debt. Rosebank came to us and said, would you help us by raising some money, because we think we can buy these businesses for not very much, sort out the balance sheets, and then create a lot of value. And we said, we know you, we've worked with you previously. We think you'll do a good job, and it appears to us that there is a good opportunity to deploy capital and create value. So we backed them on that, and we've been adding shares recently. And GSK is another one to highlight. For many, if not most people, are familiar with GSK. The United Kingdom is world-class in science. Scientific output per capita is right up there in the world. The southeast of England competes with the east coast of the US, the west coast of the US, and China. GSK has been going through the doldrums for a number of years. We think things have changed. It takes time, but the change started 4 or 5 years ago, and we think we're starting to see that bear fruit. So we've been adding to the position there. Now, to summarize, we feel that we are an experienced team with a good track record of delivering in different market conditions And we think we have a process of focusing on this cash flow that means that we can deliver sustainably over the long run without relying on a favour from tailwinds or market conditions. There's a consistent approach to this gearing, which we think can enhance the total returns within reasonable bounds. It's quite a conservative level of gearing by some measures. And we think the structure is attractive, not just for that, but for the quarterly dividends. And I would highlight again this discount to the NAV that exists in the share price of Murray Income Trust. And we have this commitment to retain and enhance the trust's dividend hero status and to enable it to become a total return hero as well.
Was there much change to the portfolio when you took over as manager?
When we became managers of the Murray Income Trust, we inherited a collection of assets, some of which we liked and owned, many of which we weren't so familiar with. And we made the decision to change the portfolio to be more in line with the Artemis Income Fund. And we changed around 75% of the portfolio. We did that in the first month. And the first month was one of the more challenging ones in the market in recent times because it coincided with the conflict in Iran. So there were some quite substantial share price moves. But we're very pleased to say that we transitioned that 75% of the portfolio within a month. So we were really able to hit the ground running.
What is the yield on the underlying portfolio and how does that compare to the trust's dividend yield?
The investments held in the Murray Income Trust are generating a forward-looking dividend yield in the high threes, and that is well covered by cash flow. Very important for us that there's good cash cover of the dividend. That dividend yield is supplemented by share buybacks. It is growing underlying. And at the trust level, it is enhanced by the gearing which the trust takes, and that puts the dividend yield into the fours.
Are you seeing good dividend growth coming from the portfolio?
We are seeing quite attractive dividend growth in certain parts of the UK market, to which we have exposure. The cash flow is growing and dividends are growing in the high single digits over the past year, in fact, into the double digits. Looking forward, the dividend growth may be slightly slower, but nonetheless, it is growing at above average rates. And also, it is being enhanced by this constant share buyback that is happening at around 2/3 of the companies held in the Murray Income Trust. As companies buy back shares, so the share count shrinks, and so the dividend per share rises.
You have some exposure to mid-caps and a tiny bit in small cap. Some of these companies are quite cheap. Why not have more?
Our sweet spot tends to be at the lower end of the FTSE 100. That is because those are companies which are big enough to be analysable, to be real, meaningful, to matter, but small enough they've still got a good runway of growth. And that's where we prefer to find our investments. That's where we are seeing a lot of opportunity. We are not intending to do anything different just because this is a different structure. We have been asked about whether we would go down what's called the cap scale to buy smaller companies. We are not intending to do that.
Would you ever hold a company that didn't pay a dividend, but you thought offered a lot of upside?
We are income investors, which means we're focusing on the cash flow and sustainability of dividends and dividend growth. But there's a spectrum of dividend. Some companies offer higher yields but are slower growing. Some have lower dividend yields but are faster growing. We think it's important to have a balance and a blend of both. We wouldn't go particularly to one end of the spectrum as a preference over the other. We will, in fact, own companies where the dividend yield is significantly lower than the market if we think they're on a path to recovery or faster growth. And recent experience emerging from COVID has shown that that's paid off, where companies had to reduce their dividends. Many or almost all have come back with strong cash flows and growing dividends a couple of years later.
Your largest holdings are banks. What is the attraction of those?
We have exposure to banks at around 14% of the assets which we're managing. Why do we have those exposures? Well, we think the risk reward is really quite interesting and supportive. Shares have performed quite well, but as we look forward, we see further opportunity. Why is that? Two main reasons. Firstly, post the financial crisis, interest rates were very low. Banks don't like low interest rates. It's hard to make money. And then secondly, regulation was really quite challenging for them. We now have a situation with more normal interest rates, and the banks are somewhat rehabilitated where they have built up capital, they have learned lessons, let's say, but they are working with regulators and they're trying to be more proactive in lending and helping the economy to grow. Valuations are attractive, dividend yields are high, and we think they have scope to grow, so we continue to run the positions.
How have you adjusted your exposure to energy stocks against the backdrop of the Iran war?
We have not adjusted our exposure to energy stocks despite the backdrop of the conflict in Iran. But broadly speaking, it's our view that oil markets find a way of reaching balance. Once again, they tend to flow from one place to another, as we found after the Ukraine invasion and Russian sanctions. Those aren't typically the type of investments that we're looking for, the short-term demand-supply imbalance. So we haven't really adjusted that. We have actually been leaning almost the other way to look at businesses where the shares have traded off because of concerns over the Iranian conflict. We think those get priced in, have been priced in, and we see opportunity to go the other way, as I say.
Global Opportunities Trust is a flexible global equity strategy that is focused on generating attractive real absolute returns over the long term. And the key to that is deep fundamental research and high conviction stock picking. We have a significant focus on preserving capital in falling markets, which we try to do in a number of ways. First, we build the portfolio from an absolute return perspective, and that leads to a portfolio that looks very different to other trusts and even open-ended funds. And secondly, we're willing to actively de-risk the portfolio significantly at times by raising cash, investing in bonds, or even hedging. I think the strategy should appeal to investors that share our view that equities are a very attractive investment universe, but equity markets don't always go up, and a strategy that can navigate those tricky times when markets are falling is particularly attractive. Hello, I'm Alan Bartlett. I'm one of the portfolio managers on the Global Opportunities Trust. So the best way probably to think about the strategy for the Global Opportunities Trust is as a very flexible global equity strategy that has the discretion to invest in other asset classes when warranted. Essentially have three investment objectives. And the first is to compound real absolute returns at an attractive rate over the long term. And the key to achieving that objective, we think, is deep fundamental research and high conviction stock picking from the broadest possible investment universe, any country, any industry, any style of company, any size. The second objective is to generate returns that have, over the longer term, a low correlation to the broad global equity market or global equity peers. And the key to achieving that objective is to genuinely build a portfolio from an absolute return perspective. And that means ending up with a portfolio has very little overlap with indices, with other investment trusts or open-ended funds. And the third objective is to protect capital in down markets. We want low downside capture in bear markets. And the key element of that is to be willing to de-risk the portfolio when warranted significantly. And we have lots of tools to do that, from investing in higher quality, less cyclical companies to raising cash, investing in bonds, or even hedging. And the table on the slide shows the portfolio construction framework, the rules within which we operate in managing the trust strategy. And you could think it looks somewhat like a hedge fund framework. And in some ways, that's very appropriate. You can think of the strategy as being a very flexible equity long-short fund that doesn't really short very much. So why does the strategy exist? What's the reason for it, and where will it fit? And it's a bit of a long story, but I'll try and do it in a shorter way. Ultimately, we think that the forces that shape the world are evolving. The conflict between those forces is going to drive shorter cycles, shorter macroeconomic cycles, shorter interest rate cycles, industry and style cycles, and that in order to prosper as an investor in that age of conflict is going to require a more flexible approach to investing. So if you sort of cast your mind back to the 30 years to COVID, think of that as being the age of globalization. And globalization was essentially supported by the benign confluence of these four forces. We had 800 million Chinese people joining the global workforce. They could only join the global workforce because of advances in technology, in supply chain management and logistics, for example. Americans were able to get cheaper fridges because the electricity that was used to manufacture them was created through coal-fired power stations in China. So ignoring the real cost of environmental damage had the effect of reducing the cost of production. And post the Berlin Wall fall, post Tiananmen Square, US and European foreign policy was that if we help Russia and China become richer, ultimately they would transition into democracies and the world would become a safer, more benign place. In retrospect, rather naive. And we think of COVID as being the tipping point, really, and post-COVID being the age of conflict. I think from a demographic perspective, for example, we have aging populations, which means conflict within demographics between old and young, rich and poor, the requirements for greater healthcare expenditure, geopolitical tensions at the moment from a security perspective are driving increases in defense spending, but you can't have it all. So if you spend more money on guns and ammo, how do you also spend more money on healthcare? We know that we can destroy the environment, but at the same time, denying climate change is convenient if you're trying to reduce the cost of production and increase economic growth. And even with technology, which is the great hope for productivity and one that we're very bullish on ourselves, it brings conflict. It brings conflict with significant changes in the workforce and work practices, redundancy for certain kind of skill sets, and huge industrial change. And the good news, if you like, is that public equity markets globally offer huge diversity. They offer exposure to every industry, every country, every sector, every type of ultimate client, consumer of products that you could find. The potential investment universe for this strategy is probably over 25,000 listed equity securities globally. And that diversity of different types of companies reflected in their performance. All equities don't perform the same. Often they have very low correlation with each other. Even in bear markets, typically 20 to 40% of stocks actually go up. But we think equity indices act to constrain rather than liberate those opportunities and your ability to capture them in portfolios. And so against this background, the way that we think is that investment strategies to prosper over the next decade and beyond are going to have to be more agile. And we think of agile as being the combination of flexibility and focus, having to have the flexibility to navigate these shorter, potentially more aggressive cycles, and then the focus to genuinely unshackle from indices and perform in a different way that isn't as reliant on broad equity markets rising over time. And that it really is the background to the evolution of the strategy to manage the Global Opportunities Trust, is to build a strategy that can genuinely hope to prosper in this different kind of environment that we envisage. So we have 3 portfolio managers on the team. Sandy has been managing the trust since its inception over 20 years ago. And the key evolution in the life cycle of the strategy was in 2021 when the policy was changed to give it more flexibility to be managed in the current way. And that's when I joined Sandy managing the portfolio. And more recently, James joined Goodhart in very early 2025 and joined the portfolio management team. But the truth is that this is a team strategy, and there's a whole team of 9 investors behind this strategy. And the thing that's really important about that is there's 9 people have very different approaches to investing. And that's critical because as investors, the first step of the investment process for running the trust is to try and cover everything. And we want to cover all listed equity securities globally, regardless of country, industry, or size. And very importantly, we think in terms of covering all stages of a company life cycle. And the kind of skill set that you need to evaluate different companies at different stages of the company life cycle varies significantly. The skill set you need to evaluate small, high growth tech companies is different to the kind of skill set that you need to evaluate slower growing, very large, high quality businesses, for example. And no one investor, in our opinion, has the skill set to invest across all of those different types of company. So we've deliberately built an investment team that has the skill set to invest across all of those different areas. So rather than being a strategy that's very focused on the apparent genius of one individual investor, this is a strategy that's leveraging 9 very experienced people that invest in very different ways. So there's a lot that's different about us all in the way that we think, but unfortunately there are a few things that mean we all talk the same language as well. We're all fundamental investors, we're all very long-term oriented, and importantly, we're all focused on change, because change, to us, is the key driver of the creation of value within companies, and it's also the thing that brings the market's attention to that change in the value of businesses. And you can see change either through individual companies, for example, a restructuring, a spin-off, a capital expenditure cycle, or in the environment in which companies operate. So increases in defense expenditure globally, for example, having an impact on companies. And normally, when you see change within a company, it's reflected in change in the industry. You can find stock ideas either from looking at companies bottom up or looking at industries and macro themes top down. But the reality is that when you have really good stock ideas, they tend to cluster into groups, and those groups share similar themes. And an individual company might have multiple different themes, but your buy list, if you like, is going to comprise companies that share groups of similar themes. And then understanding what those themes are is really important to the strategy for running the trust, because at the portfolio level, when we looking to build the portfolio, understanding how those themes interact is critical. And the starting point for our portfolio construction process really is to think about what the appropriate level of risk to take is in the portfolio. If we have lots of ideas that have huge upside, then we're more tolerant of risk. If we have less ideas that are really compelling, or broad markets are very expensive, or there are identifiable macro risks, we're going to be more cautious. So the starting point is explicitly to think about what the risk tolerance that's appropriate is today. And then we take our understanding of what those key themes are that are embedded in our best stock ideas and try and build a portfolio for that level of that tolerance for risk has the highest expected return across a range of different scenarios. We're trying to create a portfolio that performs well, not just in one scenario, but across a range of different scenarios. We restrict ourselves to 6 to 10 themes to keep focus, because it's very easy to end up with lots of different things going on in a portfolio and lose coherence. And coherence is a critical thing to us. So from our perspective, a portfolio should tell a story. When you look at a portfolio, it should make sense, regardless of the perspective that you have on it, whether it's the country, sector, industry, style, thematic. It should tell the same story. Everything should fit together. We have a great deal of flexibility in how the portfolio is built, from the individual stocks, the themes, the weights. We can raise or lower cash. We can invest in fixed income in order to, keep dry powder. We can manage the currency exposure independently of the underlying stocks, and if and where necessary, we can even hedge some of the underlying risks to try and maximize the return for our expected level of risk. And what you end up with as a portfolio is sort of remarkably simple, really. And you can look at it from lots of different perspectives. So, today's portfolio, if you like, you can look at from, it's very diversified. It invests in some very small companies, sort of 500 million market cap, and some very big companies, tens and hundreds of billions of market cap. It invests in deep value companies, high quality companies, fast growing companies, special situations. So it's incredibly diverse. But from the other perspective, it's very focused. It only invests in 6 themes. It's only 24 stocks, and pretty much the whole portfolio is in food, drink, telecoms, healthcare, defense, and a bit of Japan. And so there's an awful lot of the investment universe that the portfolio has no exposure to whatsoever. You can also look at it as a flexible global equity strategy, flexible global equity strategy that currently is very defensively positioned with a lot of cash. The underlying portfolio is attractively priced, we think. It's certainly a significant discount to global equity markets with high forecast return, earnings, low debt, high quality, a decent yield. So looked at as a pure global equity portfolio, we think it's very attractive. You could also look at it as a hedge fund. You could look at it as a hedge fund that had low net market exposure, low gross exposure, low correlation to equity markets. And the truth is that all of those perspectives on the strategy are entirely appropriate and correct. It's all of those things. And we think the portfolio fits very neatly into the alternatives allocation of investors. It's a complement. It's had very low correlation with sort of global macro and equity long short and things like that. So it's additive alongside those kind of things, or has been additive alongside those kind of things in portfolios over the 4.5 years that we've been managing the trust in the current strategy. Or you can also look at it as a multi-asset, as a complement to multi-asset strategies that sit within the investment trust universe. And some investors have looked at it from that perspective. So the Global Opportunities Trust is a strategy that takes responsibility for both the risk and the return side of the equation. It's absolute return-oriented long-term strategy with a particular focus on being able to navigate down markets. If you're interested in the strategy, please reach out to us. We're friendly people. We'd love to talk to you. Thank you very much.
Why is the trust holding so much cash?
That's a good question. I mean, there's a number of perspectives on that, but probably the most important one is that cash can be seen as a residual. In simple terms, we can't reduce the cash from where it is at the moment without changing the risk tolerance of the overall portfolio. And at the moment, we're trying to manage the portfolio to have, at worst, 20% equity market downside risk. So if the global equity market went down 25%, the most that we think is acceptable in that environment is to go down 5%. And so we build the portfolio around an explicit risk tolerance. And at the moment, we're in a very defensive position. Cash and fixed income exposure is very high. We'd love to get the cash weighting down, but at the moment, we don't think the opportunity set warrants taking on more risk in the portfolio. But it will flex over time. It's just very defensively positioned at the moment.
Is anything keeping you up at night? AI, SpaceX IPO, the Iran war, for example?
Well, I'm completely neurotic, so yes, but I think all portfolio managers should sleep badly. I think the key one really is that risk tolerance, actually, is we have lots of really interesting ideas from across our investment team, particularly in technology, in software businesses that have sold off quite significantly in recent months. And it's really trying to reconcile how attractive those new stock ideas are with our very defensive positioning in the portfolio. And so there's a sort of tension between the two things. We think it's very healthy. That's the kind of thing that should keep you awake at night, because we should be pushing to try and get interesting stocks into the portfolio. But at the moment, we continue to think that it's the patience is the critical thing at the moment, to just wait. And it's not quite compelling enough from an absolute return perspective for the portfolio today. But that's the biggest topic of conversation within the team at the moment. And a great thing about having our team and us all being partners in the business is everyone's sort of pushing in the same direction. Everyone's trying to help performance, and our more growth-oriented colleagues are very optimistic about their stock picks, and quite rightly, they're pushing hard to get those stocks into the portfolio. If you were, myself, I'm more of a kind of value-oriented manager. If I didn't have that on the other side of the table, it would be too easy to ignore. And so I think it's right that portfolio managers don't sleep well at night.
What drove the 10.3% NAV return?
Last year, you mean? That's a nice question, because it was good stock selection. Obviously, market exposure in the strategy has been very low, so the net asset value performed a lot better, if you like, than it should have done, given the amount of cash and the low weighting in stocks. And we had a few stocks that just performed extremely well, and It's as simple as that.
The discount has narrowed a bit. What is driving that, and will it close further?
Well, we hope it closes further for sure. I mean, I think one thing is that we launched an open-ended sibling to the trust in November last year, and a number of investors that we've talked to who have invested in the open-ended fund have also invested in the closed-end in the investment trust. We think they're very complementary to each other because it makes the trust strategy more relevant to a broader range of investors. Clearly, if you like the underlying strategy and you can buy it at a discount through the trust, that's pretty attractive relative to an open-ended fund that necessarily is priced at net asset value. And I think over time that should help to bring the discount in. But clearly, the performance has been at least respectable for the last 4.5 years. We've compounded ahead of global equity strategies with a less than 5% volatility and no correlation to global equity, multi-asset, hedge funds. So the risk-adjusted return of the net asset value looks very attractive. It's somewhat obscured by the share price itself, which obviously bounces around a bit more than the underlying net asset value. But I think investors can see that, and clearly if it continues to do that for the next few years, that could be very attractive, particularly if equity markets, less exuberant, should we say.
How sustainable is the dividend?
The dividend, we don't specifically target the dividend, but we are very attracted to companies that generate attractive dividend yields. So I would hope it is sustainable over time. At the moment, we are invested in a number of companies that have high dividends that we think are very attractive. But what we won't do is invest in companies just because they have a high dividend yield, because often those are companies that don't have sustainable profits, that may be too cyclical, etc. And when you invest in companies like GQG, for example, that has a 12% yield, where you think the underlying business is very robust and the capital appreciation potential over the next 3 to 5 years is really very attractive. Clearly, we have a significant preference for high yielding alongside that where we can find it. So it is a balance, but we think it should be sustainable, certainly with the way that we're thinking at the moment in positioning the portfolio.
Your Debenture has two distinct sides to it. 84% of it is an equities portfolio run by Janus Henderson. 16% of it is an independent professional services business, which is a collection of businesses, things like pension trustees, corporate trustees, and corporate services. It's got two distinct sides, but we think they work really well together. And to give you the 30-second summary of why, from an investment portfolio side of things, what it means is that we being Janus Henderson, know that in any given calendar year, we have roughly a third of the trust income in the bag from the professional services business. It means that from an equity portfolio perspective, we can have a broader investable universe. We're not confined to the largest income payers, often in the FTSE 100. We can go down the market cap scale, we can go to different types of companies, and we can show that that's improved the performance over the long term. Hi, everyone, and thanks very much for joining. I thought before we talk about performance, just a word on what is Law Debenture, because it's a very unusual structure. So I'll just take a couple of minutes to explain it before we get into more detail. It's about a 1.6 billion UK equity income trust that sits in the UK income sector, but it's got a very unusual structure. It has 84% of its NAV as an investment portfolio run by Janus Henderson, where I work, and it also has 16% of its NAV as an independent professional services business. So this has a collection of pension trustees, corporate trustees, and a mixture of corporate services business. So think things like escrow services and whistleblowing services. So that makes up 16% of the NAV. It's about a 200 million valuation on that, which is roughly 10 times EBITDA. But the reason, because I know it's very unusual to have a portfolio alongside a professional services business, the reason the two of them work together well is that they each bring something different. So for the IPS business, being part of the collective group means they become a FTSE 250 business. It means that they're able to go out and win more work. Well, whereas for the investment portfolio, and as a reminder, that's where I work at Janus Henderson, the independent professional services business provides additional income. So while it's 16% of the trust NAV, most importantly, it's roughly a third of the trust's overall income. So what that means from a portfolio management perspective is that we being Janus Henderson, know that we have roughly a third of the income for the trust in the bag in any one year, and that affects how we run the portfolio. It gives us a bigger investable universe. So it's an unusual structure. It's got two very distinct sides to it, but we think they work well together as a blend, and we can show that we think they work well together as a blend by the performance over time. So this shows the performance over a shorter term basis, but also on a much longer term basis. You can see that this trust has outperformed its benchmark, which is the FTSE All Share, over 1, 3, 5, and 10 years. And it would also, if you went back further, so more like 25 years. If we focus just for a second on the year to date, I know that's a very short period of time, because in a couple of slides' time, I'll talk about the 3-year performance and show the drivers of that. But if we think about year to date, it's been a very up and down year, as I'm sure everyone listening will know. So what's driven that roughly 3% outperformance? It's been a combination of takeovers. Those following the UK market will know that takeovers have been an ongoing feature of the UK market, we believe, because of the valuation discount there. If we think about takeovers this calendar year, this portfolio, we've seen bids for the likes of Senior, which is an aerospace components business that was bid for by private equity, and Schroders, another fund management company that was bid for by Nuveen in the States. So we've seen an ongoing level of takeover activity in the portfolio. And then more unusually, we've seen some of the alternative energy companies perform well. So in this spike in energy that we've seen since the Middle East, it's led people again to think, well, what can we use alongside or possibly in replacement of fossil fuels, particularly in areas that are suffering from power scarcity. So what do I mean? I mean, where data centers are going up in the US, for example, very fast, they need that power. The likes of Ceres Power, the likes of ITM Power, potentially provide a quicker alternative power source for those types of data centers. So the likes of Ceres has performed very well this year. So it's been those two, so we think takeovers and also those more alternative energy names that have driven that year-to-date outperformance. And then at the other end, what's hurt calendar year to date? Well, UK interest rate expectations have definitely changed. With that war in the Middle East, we've seen a rise in, again, a modest rise so far, but likely more to come in terms of inflation. That's kicked out the potential for interest rate cuts in the UK and hurt more interest rate sensitive areas like commercial property, like building materials, I think the likes of Marshalls. And those have detracted this calendar year, but overall, really pleasing to see ongoing outperformance in the portfolio. And that's definitely been helped, still being helped by the overall structure of the trust, because things like Ceres Power would not be paying a dividend yield and won't be for several years. So it would be very challenging to hold in size in a more traditional income fund structure where you were trying to meet the benchmark level of dividend yield, so which is 3.5% every year. If we now flick to dividends, this is the dividend over a long period of time, going back 20 years or so. And what it's shown is that the dividend has steadily grown. It was held once during the financial crisis, so unfortunately you won't see us on the sort of dividend hero list, but dividend growth is a real focus for the board. We paid about 35.5p of dividend last year, but the earnings per share for the trust were higher. They were more like rounding more like 37p. So this is a natural level of yield that's coming from the portfolio. And at the moment, the trust dividend yield is about 3%. And that dividend grew 6% odd last year, so comfortably above UK inflation. So if we now turn to the investment approach, and just as a reminder, this is for the 84% of the NAV that is a largely UK equities portfolio managed by Janus Henderson. So how do we manage it? How do we what's the approach? The approach is very simplistically to grow capital and steadily grow income. And the really nice thing about managing this particular trust with its unusual structure is that we can very much focus on growing the capital and treating the income as more of an output. And again, the reason for that is because of that point around it, having the third of the income for the trust sort of in the bag from that IPS business managed by LWDB. So what does that mean from a portfolio perspective? Well, it means that we have a bigger investable universe because we're not constrained to the big income payers in the UK, which I think a lot of people on the call would be familiar with, the HSBCs, the GSKs of the world, the Tescos, not in any way saying that those are bad companies or bad investments, but it's that the structure here allows the investable universe to get that much bigger that we can have a greater diversity of holdings, and we can show that that's contributed to some of the outperformance over time. So it's about that bigger investable universe here, and therefore that ability to treat income as more of an output. In terms of how the portfolio is constructed, it's deliberately diverse. So what do I mean by that? I mean that in effect, you could think of the structure of the trust as having one holding that's 16% of the NAV. Now, clearly the 16% isn't managed by James and I, but it's just that you could think of the trust in that way. And therefore, with the investment portfolio, the position sizes are quite modest. We're not taking too much stock-specific risk. And that's partly because we're trying to, you could think of us as diversifying away from that 16% of the NAV that's in one holding. So along similar lines, we've got 150 holdings in this portfolio, which would definitely be towards the upper end of the sector. And that's partly because of that uniqueness to its structure. In terms of the investment process itself, Janice Henderson and how we run the trust is very contrarian. Well, it is contrarian. We're buying good quality companies that are well managed, that importantly have the capacity to grow, because it's ultimately sales growth and earnings growth that drives dividend growth. But we are buying into those holdings at a point where they are undervalued for some reason. So it could be that people are questioning the management team. It could be that people are questioning the balance sheet or even just the sector, possibly even just the country. UK equities as a whole have traded at a discount for some time, but that we think that there is too much pessimism reflected in that valuation, so that we're able to buy these good quality companies, but at an attractive valuation. We are valuation focused. We think that's, we know that's because being valuation focused means it gives us an additional margin for error, basically. If you're buying into a company that's on a lower valuation to begin with, implicitly we think there is less downside and maximum upside, because the best total returns have come in this portfolio where we've seen both the earnings uplift and the valuation uplift happen at the same time. And I'll give you a couple of examples of that in the next few slides. So we're looking for that type of opportunity where we can have that real compounding effect of valuations going up and earnings up at the same time. And then finally, we do also go overseas in this trust. We have about 10% overseas weight at the moment. And where we use that is where there is no UK equivalent company. So we've given the example here of Toyota. There's no UK listed auto OEM, but we've also used it in sectors, we still use it in sectors like pharmaceuticals, where we hold some of the European names like Roche and Sanofi. We also hold Bristol Myers in the States. And the thinking there is that why restrict ourselves to just within that healthcare sector, things like AstraZeneca and GSK, which are really the only two large cap healthcare names in the UK. Why not expand ourselves globally to be able to benefit from that sector if we think there's a valuation opportunity there? So we now, I touched on the calendar year to date drivers of the outperformance, but much more importantly, what have been the longer term drivers of the outperformance? Because for a bit of context, this is not a high turnover portfolio. This would be a portfolio with a turnover of about 20%. On average, we would hold things for 5 years. So a 3-year driver of performance is much more relevant than calendar year to date, which is still, we're still pretty early in the year. So in terms of what's driven the 3-year, this is the largest stock contributors on an absolute basis in the 3 years to the end of December. And what strikes me looking at this table is how many of these have come from outside of the traditional income payers in the UK. So for example, Rolls-Royce, actually 5 of the top 10 would have come outside of that space. So Rolls-Royce, M&S, Kia, Babcock and Flutter, all of those would have been comfortably lower than the benchmark, the FTSE share level of dividend yield over this time period. And some of these are now back on the dividend paying list. So things like Rolls-Royce, M&S, Babcock are now back paying dividends, but they are pretty modest dividends, and they would have been challenging positions to hold in size during this 3-year period if you were trying to meet the FTSE share level of dividend yield. So what strikes me on this 3-year table is just how much has come outside of that traditional income area. Not, by the way, exclusively. Something like Tesco would absolutely have been a good income payer over this period and has performed very well as a sort of good compounder stock, and very well managed, reasonably conservative balance sheet. So it's not to say that, that bigger investable universe that Lord Debenture has is not in any way trying to say that some of the best performers won't come from that income generating space. And I think they absolutely will. And perhaps in the next 3-5 years, it could be the more traditional income payers that are the top contributors. But it's that we have the greater optionality to, yes, invest there, but also invest in more different areas. And hopefully at different times, different areas of the portfolio will perform well. And that's definitely what we've seen in the last couple of years. Sometimes it's the recovery shares like Rolls-Royce and M&S that perform well. Sometimes it's the alternative energy names. That was the case during that sort of COVID type period as well. So we want different elements of the portfolio to be doing well at different times. And that shows the diversity of the underlying portfolio. So definitely zero low dividend yield shares, and the ability to hold those has helped the 3-year performance. And then as sort of the opposite side of the same coin, we haven't had to hold companies that might be good dividend payers, but where we think the organic growth is quite modest. So things like the consumer staples, the likes of Unilever, have been relatively poor performers over this period, and we have largely avoided those areas. Now, those areas have now derated, and we might well look at them again, but we haven't felt the need to be there at a time where we felt the organic growth was pretty modest. And then finally, and actually it's not on the top 10 at the moment, it sort of dips in and out of the top 10, but we have benefited from that ability to go overseas, and particularly with some of the US holdings, like Cummins, have helped the longer term performance. So that's sort of where we are in the performance. If we look at what we're doing, we have added to the UK weight in recent years. It's about 90% now. This would be at the upper end of where it's been historically. At times it has been sort of 80% odds. So we've gradually added to that UK weighting over time. And in terms of why, what this chart is getting at is that, so if we look at where the UK is trading right now, it's trading at about a 35% discount to the MSCI World. So when you draw a line across from 0.65, that's what that's saying. It's saying the UK is at a 35% discount. And what it's also showing you is that the UK does normally trade at a discount to the rest of the world, but normally more like 15% rather than 35%. And the point at which that valuation discount opens up is mid-2016. No guesses, sort of no prizes for guessing what happened then. And that valuation discount has not closed in that post-Brexit period. So we think that presents an opportunity to buy what are, for the most part, well-managed, cash-generative companies at a valuation discount to overseas. And by the way, people often, when I show them this chart, say, completely rightly, that the UK makeup of the index is different to overseas. We do have less tech. That's the main difference. But even when you sector adjust this chart, it doesn't become a 35% discount. It becomes more like a 20% discount. But that valuation discount is still there, even on a sector adjusted basis. So that's top down. We are adding to the UK. If we now get to individual stocks, and this is sort of more recent what we've been doing, if we think pre the war in Iran, the real focus of the market was AI disintermediation. And so if we think this is in February, the likes of RELX, LSEG, the London Stock Exchange, were derating but performing really poorly. And we took that as an opportunity to buy new holdings in both those names, RELX and LSEG. And we were buying, though, RELX got to about a mid-teens PE, got to a market level of dividend yield. We think it's a really good quality company that the market was becoming overly pessimistic on. Similar story for LSEG, so we bought both of those. Commercial property is something we've been adding to for longer. So that's now about 6% of the portfolio. These are companies where they're trading at, named Landsec and Shaftesbury here. Landsec is trading at about 35% discount to NAV, Shaftesbury more like 40%. But then when you read the company results, they're talking about really good levels of rental growth, low vacancies. In other words, you wouldn't know from reading the fundamentals of the company, the results, what the share prices were doing, and that the share prices are trading at substantial discounts to often recently proved book values. So we continue to think commercial property is an interesting space, and that's about 6% of the trust. And then finally, and these are more sort of esoteric, but we often look for some of the parts potential. In other words, where the market is focused on one division and potentially missing another. So for something like ITV, everyone listening will know what ITV is in terms of its commercial broadcasting business. Also has a really large production company, a studios business that is potentially missed when people think about free-to-air TV and the potential structural decline there. Miss actually has a world-class studios business within it, ITV. Aberdeen would be another example where people focus on the fund management company, but Aberdeen also owns Interactive Investor, which is growing very strongly within the group. And then in terms of how we're funding these things, takeovers has been a big source of cash for the portfolio. So the likes of Schroders and Senior that I mentioned earlier, we've now sold both of those names. Earlier on this year, we also had a bid for insurer Beazley from Zurich, and we've moved on from that as well. So that's often what generates the cash for the portfolio. And then we also think it's really important to keep taking profits in names where the valuation has moved up meaningfully. So the likes of Rolls-Royce, we have taken very considerable profits in over time because it has generated that very strong 3-year and longer return. I won't dwell too much on the individual portfolio. The only thing I wanted to point out here is that you see that the individual stock weights are quite modest, certainly compared to some of our peers. So that's well diversified, as is the sector exposure. What looks like it's not well diversified on these pie charts is the geographic exposure, because we do have 90% in the UK. But it's really important to remember that a lot of those companies that are technically listed in the UK are not overly exposed to the UK domestic economy. So while 90% of the portfolio is listed here, it's only 40% of the portfolio that's actually exposed to domestic UK. Because the likes of, if you see here in our top 15, GSK, HSBC, these companies are listed here, but they're very global. So it's only 40% of the portfolio that's truly in the UK. And that would compare to about 25% for the FTSE All-Share. So we do have more domestic exposure than our benchmark, but it would be more modest than the pie chart would imply. So to finish up, and then we'll go through some questions, we don't think there's a shortage of opportunities in the UK. The valuation discount is still there versus overseas. We think the takeover activity that we're seeing demonstrates that very clearly. So we think there is a valuation opportunity to be had, and the structure of this trust, the unusualness of the structure of this trust, we think provides a very good route to taking advantage of that opportunity. Thank you.
What are the advantages of having the independent professional services business sitting alongside the equity portfolio?
So there would be advantages to both sides of the business from having the other side, but given that I run the equity portfolio, the advantages specifically for the equity side of the trust is really the income generated by IPS. So what that means from a portfolio perspective is that we can look across the breadth of the UK market rather than more specifically at the large cap income generators in the FTSE 100, some of which might be great investments, but it's about having that breadth of investment universe that the IPS business brings. That's the key advantage from the portfolio perspective. From an IPS perspective, and clearly the chief exec of IPS would be much better placed to answer this, but he would definitely make the point that being part of a FTSE 250 listed business does bring additional brand awareness. It brings additional credibility that I'm pretty sure he would say would benefit the IPS side of the business as well. So the benefits definitely work both ways.
You must be proud of your AIC Next Generation Dividend Hero status. How important is this for you?
We're really proud of it. And then, like I said, the income generation is a focus for the board. What I would say, though, is that I think it's really important that the income from the portfolio is a natural income. We're not distributing out of capital. I think that's really important, because while we know that income is a focus for people and they want the predictability of that income, from a total return perspective, I think it's really important that it is a natural income, so that from a portfolio perspective, we're not chasing individual dividend yields. We are thinking about it from a total return perspective. And I think that has been really key to the outperformance of the trust over time.
Are further dividend increases sustainable in an uncertain interest rate environment?
In terms of dividend growth, what we're seeing companies put through broadly modest level of dividend growth. And UK companies, they're not so much, well, not at the moment, being impacted materially by the interest rate environment. But company boards are thinking carefully about their valuations. And what I mean by that is UK companies, because of the level of takeover activity that we're seeing, company boards are often choosing to go down the route of, rather than paying, for example, a special dividend, doing a share buyback. So when I think about dividends in the UK, I'm not so much thinking about the interest rate environment. There will always be external factors that impact companies, whether it's the commodity price environment, whether it's inflation more generally, whether it's interest rates. But there is definitely a trend in the UK in terms of dividends and income generation for company boards to be thinking more down the share buyback route. So from a UK dividend perspective, I think it's more that could be the long-term limiting factor on dividends if nothing changes. If more UK companies feel their shares are reflective of the fundamental value of that company, I think it could, the pendulum could well swing the other way and go back towards dividends. Fashions change and things come in and out of fashion. But for the time being, I think it's more that capital allocation factor that's potentially limiting dividend growth rather than interest rates per se. Now, what I don't want people to take away is that I'm therefore worried that there won't be dividend growth. I think there will be, but I would expect it to be more modest than would have otherwise been the case.
How do you view owning non-dividend paying companies? You have had a lot of success with
the bank weighting in the trust would be in the low teens percentage. That would compare, it would be slightly below the benchmark weight. The FTSE share weight would be more like 15, 16 from memory. So we would be modestly underweight banks, but still a very large, absolute weighting in banks. And it's definitely a relevant question to think about for the trust. So with the bank holdings more generally, they've re-rated clearly very strongly in recent years. The likes of NatWest and Lloyds were at one point trading substantially below book. They're now substantially above it. But we don't think that the valuations have reached a point where they're stretched. We think what we'll see, this is a forward-looking view, and clearly we could be wrong, but what we think we might see is that the banks become more of a compounder from here, where as shareholders we get a good level of dividends, a good level of buyback, and some steady earnings growth, but that big re-rating phase as we came out of Ukraine and that the interest rate increases that we saw, we think that phase has now passed. In terms of what interest rates mean for the banks, interest rate forecasts in the UK are moving around all the time. At the moment, they're forecasting a modest increase from here. They had previously been forecasting a modest decrease. I think rather than getting too tied up in the minutiae, what we are seeing for the banks is a pretty low level of loan losses. They've been really conservative in their lending in recent years. So even when rates went from basically 0 to 5-ish, we didn't see much of a loan loss cycle. So I think broadly, we see them as compounders. I think they'll continue to be good income payers. We haven't tended to go there to take profits because we think that the valuations aren't stretched, whereas we have gone to places like aerospace and defence. So we have reduced the likes of the Rolls-Royce and the Babcock last year, where we were more worried about valuation levels.
With a large number of stocks in the portfolio, how do you balance the needs of diversification and conviction?
It's a very good question. We think that ultimately the route to capital preservation is diversity. So there will always be, a bit like I talked about in the presentation, there will hopefully be different elements of the portfolio performing well at different times. We often say we want to have not all of the gardens sort of in bloom at the same time. And that might sound a strange thing to say, but in a way it would worry me if I were to see, if you're seeing everything in the portfolio do well at the same time, it shows that there isn't true diversity in the portfolio. But ultimately, we think it is that diversity that means that capital is preserved and grown over the very long run, which is how we think about this type of trust. We're not thinking on a 6-month, 1-year horizon. We're thinking on a 3 to 5 year horizon. And it's that diversity that we think and compounding steadily over time that drives and has driven that outperformance over the long term.
Hello, it's time to take a step back from what we've been hearing from the fund managers, and let's take the temperature of the investment companies market at the moment. I'm Gavin Lumsden, I'm head of news at QuotedData, and I'm delighted to say that with me today is Jonathan Davis, the well-known editor of the Investment Trusts Handbook and presenter of the Moneymakers podcast. Jonathan, thanks for joining me.
My pleasure to be here.
Okay, so how are you feeling about things in the investment companies world? I kind of say it's clearly been a volatile year so far with artificial intelligence and the war against Iran making markets very turbulent. But I think there are reasons to be positive. What would you say?
I think definitely reasons to be positive, yes. I mean, if we look back, 3 years, which I did the other day, have a look back at the thing. I remember well-known fund managers saying this is the golden opportunity to buy investment trusts. And since then, they have recovered strongly after a very difficult period. More than 100 trusts have delivered a compound rate of return of 15% per annum since then, which is pretty good, let's be honest. And the number of gainers has outnumbered losers by 4 to 1. So all good. And this year so far, well, as you say, volatility. We had the Iran war. Trump throwing another, if you like, another big curveball into the market equation. But we've ridden through that, as we did last year with the tariffs. And the sector's doing quite well this year. I mean, it's up 10% roughly in the first half of the year. That's bang in line with the long-term return from equities, 6 or 7% real. It doesn't always happen, like, of course, much more volatile in between. But yes, it's done well. And a number of trusts have really put in some very strong performances.
And the discounts, the gap between share prices and net asset value, on average has come in a little bit. It's around 11%, and it was 12%. It's not much, but it did widen quite considerably around March because of the conflict in the Middle East. What's been impressive? There's been quite a range of good performances in the years so far, notwithstanding that volatility. What performances have stood out for you? You've been looking at 3-year returns, but on a 3-year basis or even year-to-date basis, what's made you sit up?
It's been a very interesting period. I mean, over the last 6 months, yes, I mean, we've seen big tech and technology-related trusts, so those who've invested heavily in AI or other kinds of tech, they've done exceptionally well. And of course, that so often is the case in markets when everybody, all the media and a lot of punters are saying, it's all overblown. This bubble is going to burst soon, which of course it will in due course. But they've been in the top of the performance tables. So if you look at things like Scottish Mortgage or Polar Capital Technology, they've done well. Nobody's done quite as well as Seraphim Space. This very interesting little vehicle that's investing in space-related activities.
Yeah, not so little now. It's in the FTSE 250.
Yes, and they managed to raise some money, which is something we haven't seen a lot of over the last 3 years. They raised more than $100 million for that, which I think is terrific, via a C-share issue. So that's been great. Yeah, they've really set the pace this year. And what's more, they've grabbed the attention, I think, of people in a way that only these kind of sexy technology-related things can do. But there have been other good performers. I think I mentioned Asia and emerging markets have done well. Professional investors have been rotating at the margin away from the US towards emerging markets, and notwithstanding the big hit they took after the initial Iran war broke out, they've done very well over the first 6 months. So yes, there are some good pockets of performance.
I think Templeton emerging markets and Fidelity emerging markets stand out, I think, as really big gainers. So lots of good returns, and the 3-year returns you're talking about do show there's a lot of those growth funds don't look so clever over 5 years, but they are recovering nicely from that nasty year in 2022. Then what about Saba? There's been sort of less positive headlines around the activities of that activist US hedge fund basically taking control of the boards of Edinburgh Worldwide and impacts environmental markets. I've not talked to you about Saba before, or not for a while anyway. What's your view on their activities?
Well, I suppose the first thing you could say is that, the old saying, all news is good news, whether it's bad or good. Investment trusts are back in the headlines and have been ever since Saba started their big campaign. And that's, in a way, put investment trusts back on the map. They are, once described as the city's best kept secret, but they haven't been so secret recently. So that's a positive, I think. People are now looking at investment trusts and talking about them, and also looking to make some money out of them, which they've been able to do in the right cases. Saba Capital, well, I don't know what most people think about them. I think people don't like their tactics. Bose Weinstein, who runs Saba Capital, is a guy with his eye on the main chance. I think we can say that. He's in tradition of US activists who get involved and don't mind offending people. I think a bit of a culture shock for the investment trust industry. But looking back over the campaign, I mean, they have bought stakes in something like 50 investment trusts over the last 2 or 3 years. They've had some notable successes. Divisive in the way they've gone about it, I'm for sure. And they have indeed now prompted the FCA to come up with some new rules to try and stop them doing what they did in a number of cases, which is try to take control of the board.
Yeah, because it does feel to us that, as an activist, they're great. They buy in stakes, and if they're putting pressure behind the scenes on the board to, take measures to buy back shares or, do something to narrow the discount and basically improve the share price performance, then, that's all well to the good. But it's these attempts to take control and where shareholders have basically voted in favour of boards and strategies that does seem unfair because, they're in the driving seat. They can keep, with the big stakes that they establish, they can keep resubmitting resolutions to remove boards. So, the FCA has come out with some proposals that by the end of the year could strengthen or make it clear that where big shareholders are putting themselves forward as fund managers, that they shouldn't. The directors that they've put forward to implement that shouldn't be considered independent. But do you think, the rules aren't coming until the end of the year, so it's too late for the likes of Edinburgh Worldwide and Impacts, is it?
I think so. I don't know for sure, but I mean, I doubt they'll make it retrospective, these changes. I think that would be inviting.
Yeah.
I don't know, though. I mean, I'm not privy to
Well, I only asked because there was appeal from the Association of Investment Companies, basically for all market participants, i.e. Saba, to kind of follow the spirit of the rules before they arrive. And I don't know whether that's wishful thinking or there's some...
Good luck with that is all I would say.
Yeah, okay.
Good luck with that. I think there's stable door being closed. I mean, I think this is something that, Saba's had 30% holdings for over a couple of years in some cases. It's a bit late to get round to it now. We know things move quite slowly in these areas. I think it is useful what the FCA is now proposing. It will stop this sort of, playing the system, if you like, which is what Saba's done very effectively. And overall, though, I think Saba, my view, not always popular in boardrooms, is that net, despite all the negatives, they have been a positive force for good in the investment trust sector at the margin, because they have forced boards to confront these issues of imbalance between supply and demand. And that's always been at the root of the big discounts that have appeared over the last 3-4 years. And a lot of boards are now much more active than they were. And I do have sympathy for those who were caught in the having to work over Christmas and things like that, but doing more than they expected when they took on the job. But overall, I think boards now are much more on the ball, and they're doing more. We've seen all sorts of initiatives to sharpen up their act.
Yeah, huge increase in buybacks, increase in fees being cut, management fees being cut, and also mergers, prompting smaller funds or weaker trusts to merge with stronger rivals. Yeah, that's all good. A kind of stronger, leaner sector could emerge. We hope. Just on this topic, though, Saba trying to get themselves elected as fund manager on those trusts we mentioned. Actually, there's been quite a few sort of mandate changes and manager appointments. Any of those that caught your eye?
Yes, I mean, I think when you change a mandate of a trust, it is a big moment for the board. Or you change the manager, it's also a big moment for the board, because you could look very stupid. And if you think back to 2020, when we, after the COVID panic, we had a couple of good examples of lots of trusts in the UK equity income sector where the boards decided to take action. Some of them are very successful, some were not. Some went for a completely different approach, some went for more of the same, but with a different manager. And it's worked out in different ways for each trust. So it's a big move for a board to do that. But there have been some interesting ones recently. Only this week on my podcast, I was talking to one of the managers of Artemis UK Future Leaders, for example, which is a UK small cap trust that used to be managed by Invesco Perpetual. And Artemis, I think, a very good specialist boutique fund management firm. They used to be in the investment trust sector, but they lost one or two trusts, but they're now back in with two.
They've bounced back with two, haven't they? Not just the former Invesco Perpetual UK smaller one, but Murray Income.
Yes, and I think we've
nicked that off Aberdeen.
I think we've been hearing that, and that's a good thing, because particularly UK equities is really where Artemis is strongest, I think, and they record in equity income in the open-ended world has been immaculate, probably the very best, I would say, for consistency. So it's very good to have them back managing trusts. Obviously, we can't predict how they'll do, but the UK Future Leaders is an interesting one because it's gone particularly for a particular style of investing, more value-oriented approach, and we've lost most of the value investors in the UK. equity sector. There's one or two valiant ones still ploughing on because growth has been the place to be. But if you want to make a contrarian bet, this I think seems to me to be a perfectly reasonable one, and investors now have a bit more choice. And though it's started off with a relatively poor year, this particular smaller companies trust, I think there's a lot of upside there. The valuations are very low, and the managers have put $3 million of their own money into it.
They've been buying a lot of shares. There's RNS virtually every week with them. One of the two managers buying some more shares. Yeah, so they're showing lots of conviction there.
Still trading on a quite a wide discount, and there's a continuation vote coming up next year. So you'd think that's not a bad combination if you're a connoisseur of investment trusts, at least.
Well, the continuation vote will keep them focused on doing as good a job as they can.
Well, I think in general it does do that. I mean, there are a lot of continuation votes now being written into mandates, and I think that's a very good thing. I don't think one every year is a good idea because I think that introduces too much short-termism. But every 3 years, for example, seems perfectly reasonable to me. And if you look at another example I would give you would be Harbourvest Private Equity Trust, where they have a continuation vote coming up this month.
That's right. That's right.
And they may or may not be a coincidence. They've been among the most active boards in introducing.
They're pulling out all the stops, aren't they?
Pulling out all the stops, and I think that's particularly for the private equity, which has been in the doldrums and seen very wide discounts. I think that's a very good thing. So yes, change can be good. Obviously, it doesn't always work.
Okay. There's going through all these different examples, there's a real sense of renewal going on. Yeah, challenging times, challenging markets, and activists, putting a boot up the backside of some of the boards. But there's a sense of renewal going on. And earlier on you mentioned the impressive performance of Seraphim and how that captures investors' imagination. So I'm just wondering, we've got the kind of age-old challenge around investment trusts is how to reach new. They are the erstwhile city's best kept secret and appealing to older investors. And so there's this challenge of how do you reach new and younger investors? Have you got any thoughts on that with the performance of the likes of Seraphim or Scottish Mortgage, all those small band of trusts that are holding SpaceX, the kind of holdings that are really gripped people's interest?
It's difficult, I think. It is difficult. I mean, we know there's a structural problem in the investment trust sector with some of the wealth managers, consolidating and dropping out of the sector to some extent, and that they've been a traditional backbone of buyers. So, yeah, it is difficult finding new investors, and I think unless you accept that if you haven't got enough demand, you have to shrink. I mean, that's just logic, and I think that's what we've been seeing. But yes, attracting new investors, attracting younger investors, I think it's going to be a real challenge, to be honest, because the surveys show that the average young investor, those who do look at the market, they normally work in ETFs and things like that, which they can trade through the day. Their average research period is 20 minutes, according to some research I've seen. And that's quite difficult to explain the greater complexities of the investment trust world. So short of having fund managers dancing around on TikTok, singing songs and making themselves a bit of a spectacle, it's going to be difficult to get younger investors, I think. Doesn't mean you shouldn't try, but I think it's going to be more a case of just capturing, as investment trusts always have done, the middle-aged investor who's gradually getting older and has more time to look at what he's putting his money into.
That's often been the way, isn't it? As people get into investing, they kind of graduate towards investment trusts, having done other investments, open-ended funds or whatever, or ETFs. But I was at an event recently, Law Debenture put on. They have a kind of regular series of widening investor network events trying to promote themselves, but also investment trusts. And this particular one was aimed at younger investors. And it was quite funny because actually the audience, there was quite a few older people there as well and quite experienced investment trust investors. And the topic of Saba came up. But actually, afterwards, I did spot some of the younger investors that were there. They were genuinely young. And actually, because they were kind of professional contacts of Law Debenture, these were a group of young actuaries. So they're kind of unusual younger people. And they didn't know much about investment trusts, and they were very interested. And so it just makes me think, I don't know what the answer is, but, it's that kind of granular appeal. You're not good. Do you think I think it's difficult to run massive campaigns generically appealing for people to like investment trusts. But I think, on a kind of events like that are very good, I think, at maybe getting a few people interested at a time. Intensive work, but could pay off.
I think the other point is, I think, historically, and I think this will remain the case, if you've got a parent or a grandparent who knows something about investment trusts, or
Yeah.
professionally you have some involvement with people in the city who know about investment trusts, they are the perfect vehicle for when you're investing when you're young, much better than investing in a tracker fund when you're young, because the discounts will play out over time, as we know, and you'll do okay, you'll do very well if you allow them to compound. So I think it's more going to work that way than I don't think there's going to be some kind of mass market movement, frankly, to buy investment trusts. But and if so, they may be, we don't want kind of here today, gone tomorrow investors. We want people who are persuaded of the merits of investment trusts and prepared to stick it out for the long haul.
Yeah, because the long-term structural advantages that the investment trusts have, the closed-ended structure, the ability to borrow modest, sensible amounts of money to increase the amount that's being invested, and the ability to, obviously, the dividend advantages around being able to put some earnings aside to top up dividends, on a rainy day. Yeah, these are all really solid advantages that trusts have, aren't they?
These are all the good reasons for investing in investment trusts. I mean, I think the period we've just been through the last 5 years, has been it hasn't been exceptional in the sense that we've had periods like this before, but it has been fairly intense. And so the idea that one of the advantages of investment trusts is that it's sort of patient capital. You can go on, they've got time to invest and not have to worry about short-term performance. Well, when it goes on for 3 or 5 years, and I think you rather lose that, and I think it's going to take time to get back the idea that investment trusts are still a good place to put your money. And the proof of that will be when we actually see more new trusts coming back to the market. We get renewal, as well as we've gone through the consolidation phase. Still got a bit further to run, I think. Number of trusts is down by about a third or something. But we need to see the new ones coming in, the green shoots, if you like, for the future. And that hasn't happened yet. I mean, Seraphim Space raised some money, but apart from that, we've had very, very little in the way of new investment trusts. Achilles would be one. Hasn't done very well so far. And so I think, that's credit to those who tried that. And I think we'll look out for that, more of that in the future. But that will be the sign that we're really back. But that, of course, will also mean that discounts have come in even further. And so the, buying cheap won't be quite so prevalent.
Yeah. Okay. Well, maybe we can pick up on that topic at a future investment trust forum. But on that semi-positive note, we'll draw a line to it there, Jonathan. But thanks very much for talking to me. Very interesting discussion. And let's see what the rest of the day holds. Thank you.
My pleasure.
Baillie Gifford European Growth Trust is an actively managed, high-conviction portfolio of European growth companies, predominantly public but also private, built to compound capital for shareholders over the long term. The trust dates back to 1972. Baillie Gifford has managed it since 2019, and I became the sole manager of April this year. Around a quarter of the portfolio was deliberately reshaped at my reappointment to broaden the sources of growth. That means we have durable compounders, we have irreplaceable moats, and we have exposure all the way on through to disruptive growth types. Europe, in my view, is closer to emerging markets than it is to the US. It's heterogeneous, dispersed, and often inefficient. That's not a criticism, it's a description of the huge opportunity. We focus on the long term. The portfolio grows faster than the index, carries more resilience, and trades at only a modest valuation premium. Good day, everyone. My name is Joe Faraday. I lead European equities here at Baillie Gifford, and I took managing the European Growth Trust as the sole appointed manager on the 1st of April this year. And after that, became head of our European equities team on the 1st of May. Over the next 20 minutes, I want to do 3 things for you. First, I'm going to set out how I think about Europe, because I think the conventional view misleads us to a great deal. Second, I want to guide you through how that thinking shows up in the portfolio today, and cover what I've changed since I've become the manager. And then third, I'll talk about what I'm excited about from here on. So the aim of the trust and how we approach investing is that it's a diversified portfolio of scarce assets, local champions, and growth opportunities. The trust also has selective private company growth. There's a cap of up to 20%. And one such example that I'll return to later is bending spoons. So let's turn to why Europe in the first place. Now, I think there's a conventional view of Europe that's well known, and it's not unreasonable. Look, slow aggregate GDP, political fragmentation, the regulatory burden, energy vulnerability. We see this day in, day out when you read any of the media inputs. There's also subdued productivity for the better part of a decade, if not far longer. And I think this all leads to framing Europe in quite a narrow way of it being all about regional beta, it's a macro trade, and is not a stock-picking opportunity. Now, my view is completely different to that. I think the conventional view makes a systematic error. It reads aggregate weakness as individual company weakness, or it extends it onto that, and they simply aren't the same thing. When you say slow aggregate GDP growth, one can also frame that as mean massive dispersion. The gap between the best and the worst businesses in Europe is huge. And precisely because the macro is weaker and inefficiencies persist the longer, I think that creates a massive opportunity for stock pickers, not an obstacle. When we say political fragmentation, you describe the existence of these irreplaceable industry clusters across Europe, Dutch lithography, the Swiss pharma precision machinery businesses, Germany for its automation and engineering, the French prowess in aerospace, or the luxury maisons. These clusters took generations to build and can't be reshored or replicated easily elsewhere. And I think these are structurally very defensible and really core attractions than when you look at European opportunities through that lens. Now, that's also causing policy urgency. There's the European Chips Act, there's accelerated grid investment, there's the defense rearmament, and some of these are at a scale we haven't seen in decades. So let's pull this all together. Europe's complexities, not an obstacle. I think it's an opportunity, and it rewards the investor that does the work. So let's now segue a little bit onto where we see growth opportunities. These are 5 exposures that I've got in the European Trust, and they're quite distinct. Ultimately, it's all about driving good long-term returns. But one of the growth drivers or company types I'm particularly fond of is scarce assets. So where are their choke points? Where are their high barriers? It's about installed bases. So I mentioned earlier ASML in semiconductors. It's near monopoly in EV lithography. It's basically the only company in the world that can supply the machines enabling advanced chip manufacturing at the scale it's able to do so. ASMI is quite similar in a slightly differing area of semiconductors. Airbus is another example, though. It's sitting on a backlog that extends well over a decade in commercial aviation. And basically, there's no credible alternative supplier for most of its aircraft types. Roche is scarce, I think. It's combining a drug pipeline and diagnostics moat, and the corporate governance or the family setup there, I think, is second to none across the wider pharma space. Lonza in biologics manufacturing. So with all these businesses, it's not a case of will they grow, it's about patience being rewarded. Second grouping is local champions, domestic share gains, consolidation, formalization. So there's Dino Polska, you can think of as being the Lidl or Aldi of Poland, rolling out stores, very focused on its specific market, having high share. A third grouping would be productivity enablers, businesses that save labor, improve workflows, automate processes. And a couple of examples here would include Rationale in commercial kitchens. Their combi steamers deliver sort of huge measurable payback for restaurant and hotel operators. Nemetschek's another example that does construction workflow software for architects, engineers, taking out huge costs by minimizing error types and faster processes and cost efficiencies with materials. A fourth grouping would be what I describe as electrification and infrastructure. So a few examples here would include Iberdrola's regulated networks and renewables in the utilities space. It's got a long duration profile. A third example would be Nexans that does high voltage and subsea cables, so helping provide solutions for more electrifications or grid connect or wider input sources. Another one would be Total Energies and its role as an energy major spanning conventional E&P, integrated LNG, and also integrated power. All of these businesses deploying a lot of capital, generating high returns, and that flywheel of returns and capital deployment driving the growth forwards. A fifth grouping would be capital allocators. So I mentioned these very special aligned companies or stewardship type setups that we have in Europe in the form of holding companies. So there's Investor AB of the Wallenberg fame, Exor with the Agnelli's, Group of Brussels with the Frere family. And there's a number of these that we brought forward through into the trust. I think these are very special structures. They're durable, multi-generational, and they're compounding by their owners and have exceptional track records and formidable alignment with minority shareholder interests. The point of this is breadth. We can make progress when cycle favors capex, defensives, domestic recoveries, quality compounders, large companies, small companies. Not a single factor has to work out for this portfolio to deliver. Now, let's turn to what actually governs the businesses in which we invest. I think what I want to emphasize is that every holding is tested, it's analyzed, it's debated. We take a huge, great pride in meeting with management teams, getting close to management teams and understanding the business, the aims, the drive. So there are 5 considerations for assessing European companies. The first up is competitive position. What does this business win at and why does it keep winning? What is the crux of that edge and why does it persist? Then there's the reinvestment runway. What does the company do with incremental capital? And is that compounding period also still intact? What's the opportunity? Linked into that is capital allocation. How is capital allocated or deployed? We look for consistency. We want discipline. We want a track record. Or if there's agility, why is that? And what are you likely to see? Then there's durability of the growth. And then last up, we have to ask ourselves about valuation and expectations. European equities can re-rate, derate violently. Now, we use all the tools, reverse DCFs, peer comparison, scenario analysis. And what we're trying to do is scrutinize and accept that sometimes consensus or we can get things wrong, and the market could be right or wrong. But what we need to instill is a high degree of confidence in what we're backing, but also a willingness to let go. Let's turn on to the portfolio. Around half of the companies I describe as being world leaders. Around 20% are described as being those local champions. Around 15% is what I describe as being capital allocators. And then finally, there's about 15%, we have a cap of up to 20% in private growth. So bending spoons, which is actually performing exceptionally well. Tekeva, the Portuguese drone company. Flix, Sender, the Uber for trucks. Now let's look at the overall portfolio and all of the different holdings that we have. There are 54 positions today in cash. I see it as a truly diverse set of portfolio. It's an active portfolio. Then I come back to bending spoons. It's the largest holding in the portfolio, around 10%. This is private. It's an Italian technology business. We've held this since 2023. It's built up a portfolio of consumer software applications through very disciplined and very agile, repeatable M&A and the processes it's built around that. It basically acquires under-monetized apps, takes out costs, improves the product, reinvests. It's been one of the most successful investments that we've had in the trust and in recent history. The second example I'll give is ASML. Again, one of the large holdings. It's been an anchor holding in the trust for many years, and rightly so. Increasing semiconductor complexity drives higher lithography, intensity per node. There's more machines, more time, more value per wafer. And ASML is pretty much the only company that can execute or supply EUV machines at scale. The reinvestment runway is very long for them. The customer relationships are fantastic, if not permanent. Third example would be KBC Group, and this is a Belgian bank or a Belgian bancassurer. It's got structural growth across a combination of Belgium being more the cash cow component business, and then Central and Eastern European banking franchises that span the Czech Republic, Slovakia, Hungary, Bulgaria. And across those, this is a very growthy bank, and in aggregate, it compounds book value at very compelling rates, as well as giving a yield that accompanies that. And I think it's exactly the kind of business, a narrower type of growth. I mentioned at the very start, I took over managing the portfolio April the 1st. I changed about a quarter of the portfolio at that point. And I just want to use this point also just to emphasize some of the changes that have been made. We basically went from having one bank to 6 banks in the portfolios. They have bank assurance models. So they've got robust top-line growth. They're taking out costs. Most of them are doing buybacks. And you get to double-digit returns from each and every one of these. They grow. And I think there's going to be a persistency around that growth for the next 5, 10 years, if not beyond. There are now 6 holding companies in the portfolio. I mentioned Investor AB and Exor and GBL. There's also Ackermans Van Haren, Prosus, and MBB. These in aggregate are around 10% of the portfolio. They're selected for their track records, the portfolios, the quality, the governance. And as a side point, about 40% of the exposure of these companies in aggregate is actually on through into private companies. Another area that's changed is Germany and also Southern Europe. So in Germany, there was pretty much de minimis or negligible exposure to German companies. It's a very large part of the opportunity set. There's a lot going on in that market, but I think it's a case of thinking through, having been there, spend time with a wide range of companies and identifying what are some exceptional growth, high quality, very aligned businesses. And towards the larger end of the spectrum, there's the likes of Allianz, Deutsche Telekom, and Rheinmetall that have been brought through into the portfolio. And at the lower end of the market cap spectrum, the likes of Rationale, the combi ovens maker, or CTS Eventim, the event ticketing business that's come through into the portfolio. Southern Europe, I think Spain and Greece look rather interesting. There's been a purchase of banks in each of those markets. And then perhaps to end on just a couple of other areas of new holding types. Defense is now up to around 5% of the portfolio exposure. Rheinmetall, as I'd mentioned, Exail is an underwater drone business. There's the private holding in Takeva. And then a very last grouping would be some of the more dirty and grubby compounding or behemoth type businesses. And a company there, of one example, would be Total Energies, which is generating huge amounts of free cash flow. It's growing, it's investing heavily in CapEx and expanding its wider portfolio of exploration and production. It's the largest exporter of energy from North America, and that's growing. It's a very large player in the integrated power market, and that's growing. So that's saying a lot about individual names and lots of examples. Let's use that now to look at the portfolio fundamentals and the aggregate features of the trust. I've laid this out in 4 ways. Let's think about growth. So first up, historical growth. If we look at the features of the holdings today, they've grown their top lines faster than the market. Free cash flow, faster than the market. Earnings, faster than the market. So that's the track record, or that's the underpin. We then use that to think about what about forward growth is and what the characteristics are there. Very important. Forward sales growth on a 3-year basis, faster than the market. Forward earnings growth, faster than the market. So I think the resounding message has to be, this is a very growthy portfolio. And based on all the different examples I've given and the broader premise of the approach or underpin to the philosophy here is about the breadth of that growth that I feel is particularly important as well to overlay on top of that. Now, in terms of valuation on the top right-hand side of this slide, I believe there's a modest premium being paid. I don't think that the growth is fully captured by that modest valuation premium. And then to further underpin that, in terms of balance sheet strength, these companies are less indebted, so they're better capitalized. There's more financial flexibility. The return traits are more compelling. The cash flow generation traits are more compelling. So let me close. There's 3 things I want to leave you with. First, I think there's a huge opportunity. Europe is not regional beta. It's heterogeneous. It's an inefficient market full of irreplaceable businesses, patient capital structures, and growth that indices really fail to capture. Second, this is a portfolio built to compound through cycles, not to just chase an individual one. And then third, I'm investing alongside you in, I believe, every sense. I spent years building conviction in these business types through direct management contact, not just on-desk research. I took on the trust because I believe in the proposition, in the opportunity that Europe presents for patient, active investing with a genuine analytical advantage. My interests and yours are the same. And with that, I thank you and I would welcome your questions.
Are you taking a broader approach to growth than your colleagues in the long-term global growth team at Baillie Gifford? Looking at the three categories of quiet compounders, irreplaceable moats, and breakthrough growth, is BGEU a bit like monks?
I think the very short answer is yes. We have a broad church in terms of investment styles and approaches here within Baillie Gifford. I'm quite comfortable with the analogy of this being more monks than Scottish mortgage. I think that fits ultimately with what the opportunity set presents in Europe, and that's really important. So if you're too narrow, you miss being really out of tune. I think Europe offers many different forms and types of growth. So it's appropriate to the European opportunity set. And ultimately, I feel it's aligned with my skill set and my approach and my experience over the last 20 plus years. I made that comment earlier about Europe being similar to emerging markets in some sense. So I think that agility or that breadth to growth types is very pertinent and important. And then finally, I want to make the comment around what the board has instilled the confidence in me to do, and what I believe aligns ultimately with shareholder interests in terms of the types of performance that we would like to achieve and go after here. And that's where I'd say quite simply, yes, I'm comfortable with that analogy or that comparison with a fellow wider trust.
You made a notable increase in financials when you took over the portfolio. How do they fit into your 7 megatrends?
So let's be really clear here. I look for growth. I think about individual businesses and I concentrate on the long term. Each and every one of these fits the growth criteria. I have a saying that 10% is not a bad number, and I wind up the dial from there. I firmly believe these businesses in growth or total return sense will ultimately go on and drive and deliver that. Now, what's also quite interesting with banks is they are broader proxies or plays on a wider economy. So I would say they're almost all encompassing over these wider growth drivers. They give a breadth across a large number of these, whether it's consumer, corporate capex, Southern Europe. So they're sort of a wider exposure. Or one could say, perhaps I need an 8th group or bucketing, but I would emphasize I don't want to get too narrow with the banks. I see there being a number of opportunities across specific areas of wider Europe.
Europe is often compared unfavorably to the US from an investment perspective. Given the lead the US stock market has taken in the past decade, what makes Europe attractive to growth investors?
So the way I think about it is actually the US has had a lead for many decades, if you look over the last 50, 60, 70 years. But there have been periods where Europe has done particularly well, but I actually prefer to look underneath the bonnet of that and think about the individual company types. And it's about having exceptional companies. It's about individual businesses. And if we look at the returns from the likes of Swedish companies or Swiss companies over recent decades or the long term, it's been right up there on par with the likes of the US market. And I think if we look at individual businesses and company types as well, it can be up there right on par with the likes of the US market. I do also want to throw some caution. As I went back to the very start when I talked about some of my some comments on Europe in general, there are some big structural challenges for Europe. There are certain areas of Europe I inherently find very unattractive. So I want to be a little bit cautious about making a bland or a bold statement saying absolutely everything in Europe is fantastic. I believe it's about being very selective, and it's about going after growth in Europe, and that can generate very strong, compelling returns. And those European companies can be on par with some of the very best that are out there in the world, in the US, the Far East, and elsewhere.
The Trust's biggest holding is 10% in the unquoted Italian company Bending Spoons. Is it BGEU's equivalent to SpaceX? What does it do and how fast is it growing?
So Bending Spoons is a software business. It acquires internet platforms and takes costs out, monetizes them better, and it's got a flywheel and very successful track record of doing so. We've owned this for a few years now. We've been very close to that business, and it's really exciting, the developments it's been going through, the growth rates that it's achieved, and it's at a really important milestone. There are intentions to try and list this business this year. We are very supportive of them doing that. We feel it's the right juncture for the business to be doing so, given the scale it is now at and the leverage or the wider access that will give it to capital. So it's really exciting times for that company. It's the largest holding in the trust, and I'm excited about what lies ahead. The SpaceX analogy is an interesting one. I just want to wait and see what really happens here. But I'm very, very upbeat. I'm very, very excited for Bending Spoons.
Ashoka WhiteOak Emerging Markets Trust is managed by the WhiteOak team, which has a long-established track record of generating strong alpha. We have deployed extensive resources. We are one of the most well-resourced teams in the industry with 48 investment professionals who have extensive investing experience in global markets, developed as well as emerging markets, and have shown their caliber in extracting alpha across the market cap spectrum, large, mid, and small, in an inefficient market segment of the global equity markets, which is emerging markets. In this trust, we have the best-in-class fee structure, zero management fee, all linked with 100% of manager remuneration is linked to alpha. Alpha being the value add. If we don't generate alpha, we don't add value, we don't get paid. Only paid when alpha is generated. Ashoka. Hello, everyone. So we are talking about the Ashoka WhiteOak Emerging Markets Trust. WhiteOak, we are over $12 billion at this time in assets. The firm was founded in 2017 after I left Goldman, where I was for 17 years. At the time of leaving, I was CIO of the Global Emerging Markets as well as the India strategy. About the trust, it is £75 million, a little over at this time. Done very well, as you can see in the top right-hand side graph. The bottom graph shows that it's traded mostly at around the NAV value with hardly any discount. As a result, we've been able to do tap issuances, obviously combined with the performance of the trust. So it's grown from £30 million 3 years ago when we launched it to £75 million or above. Combination of the approximately half or more would have come from the performance and the remaining from tap issuances. It's got a very attractive and logical structure, fee structure. Management fee is zero. There is no annual management fee. There's an alpha share of 30% of outperformance over discrete 3-year periods. Every 3-year period, if there is an alpha generated, then 30% of that alpha is paid out to the team as fees. If there's no value added, no alpha generated, then the team doesn't get paid. So strong alignment with the investors. Also, these fees are paid in shares. 100% of the fees paid in shares, 50% of which is locked up for a further 3 years. On top of this, there is an annual redemption facility. Each December that is provided, that also helps keep the discount in check. Let me straight away jump into the portfolio composition, as most of you would be interested in. What does the sectoral weights look like? Top half of the slide here. More or less, we don't take top-down calls on sectors, countries, or any such factors. We believe that just introduces noise. All of stock selection, as we'll see in a few minutes, in our return attribution comes from stock selection. So you should expect, by and large, the sectoral weights to be aligned with it's not, we don't aim to completely neutralize the sector weights and make them all zero in terms of difference with the benchmark. But as long as they're within a plus minus few percentage, it's consistent with our portfolio construction approach of keeping a balanced portfolio relative to the benchmark. Some of these, obviously, classifications by the index makers is not perfectly logical, I would say, whereas we see through that. And we may have, for example, some higher overweight, as you can see, in consumer discretionary, and some slight underweight in information technology, though even though 40+% in absolute terms. But when you look underneath, maybe some of the consumer discretionary names are more akin to IT service name. They're just classified in consumer discretion. So we see through when we analyze risk in the portfolio. Market cap weights, as you'll see in the bottom left, always will have higher allocation to SMID cap, expect to have higher allocation in SMID cap. Reason is not that we believe SMID caps would outperform, but it's just that they're more inefficient segment of the market. So over time, we'll be able to extract greater amount of alpha in that segment. So we believe SMID caps, large caps, they all would perform in line over time, though over short periods of time they may perform differently, but they can be expected to deliver same return. But if we can add more alpha in SMID cap, then the total return would be higher. On the regional weights are better understood in the next slide. So you'll see that on the top row, Asia, 83% weight in benchmark. By country of listing, it's 77.5 in the portfolio, so might seem like 6% underweight, but we have about 10% of the portfolio, as you'll see in the lower side of this slide. We have about 10% in developed world companies that are predominantly exposed to emerging markets. For example, Process, which owns 80-90% of its value, comes from Tencent, which is obviously a leading company in China. So when you reassign these companies where economic exposure is predominantly, there are some caveats, I won't go into details of those here. When you reassign those, then you'll see on the right, two of the rightmost columns, the portfolio is about 82.5% in Asia, more or less in line with the benchmark. And similarly, most other regions are more or less in line with the benchmark, consistent with what I said, no large deviations. You'll see country by country as well, 2 to 3% is the highest deviation at this point. Not that we can't go beyond that, and we've been beyond that, maybe even 5 to 7% sometimes, but for most part, it's never gone past, I believe, double digits or 10% or more, unlike many other strategies which may be 20-30% aside, because in our view, it just introduces volatility of returns rather than adding alpha, which is the value add. Net democracy score tends to be higher for our portfolio. We tend to find greater number of alpha opportunities. We believe the alpha potential tends to be in some ways a function of the net democracy score. More democratic countries tend to present higher alpha opportunities in our view compared to less democratic countries. Again, the view is not that democratic countries would outperform less democratic countries. There's no evidence necessarily to suggest that. It's just that SMID caps have more alpha potential, even though they may not outperform the large caps, but stock picking can be more rewarding in SMID caps. Similarly, we believe stock picking can be more rewarding in more democratic countries, not necessarily that the market has to outperform the more authoritarian types. Same vein, we will generally find our portfolios to be underweight in SOEs. As you can see in the bottom row, we are 10% underweight in SOEs. So benchmark weight in SOEs is about 15. We are at 5%, 10% underweight. Obviously, that 10% overweight in non-SOE companies. SOE risk, while it might seem 10% higher, but SOEs are very uncorrelated, we find, across countries. So the single biggest SOE risk, as you'll see in the top row, is China SOEs, where we are 3% underweight, which is very manageable in our view. Now, if you're underweight SOEs and you're underweight authoritarian regimes, both of them tend to be lower multiple segments of the market. You will expect that the P multiple of our fund or trust would be somewhat higher, which is what you'll see here on the fourth and fifth row. First, you'll see the number of holdings are 200, which is a hallmark of WhiteOak's investment style. We always had very large number of names in our portfolio. We believe, while there's, in my view, the biggest myth in our industry is the myth of concentrated portfolios. We don't agree with that. I've got now 19 years of professional investment track record in emerging market or emerging markets in general, which provides hard evidence that a portfolio of large number of names can provide amongst the highest alpha while delivering that alpha very consistently. A larger number of names helps us also dig deeper into the small cap segment and reduces the concentration risk on those small cap names, reduces the liquidity risk in those small cap names, allows us to take exposure in smaller cap names, which other funds or trusts might not be able to because they're more concentrated. Obviously, there are other reasons as well. You need a team. It's not everybody's cup of tea to be able to invest in 200 names. If you have a 5-10 member team, it is suboptimal to invest in larger number of names. But we have 48 member teams, so on average, there are 5 or 4 names per individual team member in the portfolio. It's not a spray and pray strategy. We are doing deep due diligence by virtue of having such a large team on this small cap names, and that, as you'll see in due course, have delivered solid alpha. The ROE tends to be higher in our portfolios across time, and you'll see here about 19% compared to 13 of the benchmark. The P multiple, for reasons that I explained, at 13.7 times next year compared to 11 because of the lower SOEs, and more democratic nations tend to have a higher multiple. More importantly, the OpCo-FinCo multiple that we use internally, many of you will be familiar, is at 14 times compared to 12. Projected earnings growth and revenue growth are listed there as well. Beta of 0.91 and active share of a healthy 57%. This just shows that historically, at all times over the last 20, 30 years, least democratic countries have traded at a big discount compared to the more democratic countries. So that's one of the reasons why India trades at a premium multiple, whereas China would trade at a discounted multiple. Similarly, SOEs have almost always traded at a discount to their private counterparts. Portfolio holdings, again, would be something of interest. By absolute weights, you'll see TSMC, Samsung, and Tencent, and so on. You'll expect the larger names to dominate in this portfolio typically in absolute terms, but in active weights, you'll see on the right side, there is a very large variety of names from across large, mid, and small cap. Performance, very solid alpha generation, very consistent by and large, the alpha generation over the last 3 years. That's again a hallmark of a WhiteOak's track record. Not only alpha is very high in magnitude across portfolios compared to the peer group, or let's say towards the top end of the peer group, the consistency is unparalleled compared to the peer group. If you look at towards the bottom, 23.21% is the NAV. This is net of performance fee and other expenses compared to 20.77 of the benchmark. So more important than the performance, in our belief, is the attribution of that performance. How has the performance been generated? So next few slides, which I'm going to quickly flip through, all those slides show that it's the stock selection that's driven performance. So if you look at the rightmost 3 columns, bottom row, out of the 29% alpha, when viewed at market cap attribution, 46% has been generated through stock selection. Allocation effect, because mid caps over the last 3-4 years have underperformed, that's led to a 17% detraction. Over time, the allocation effect tends to be a zero-sum game. Stock selection is what is real skill and shines through in time. Same way, country attribution analysis, we look at the bottom row, last 3 columns, more than 100%, 32 out of 28 has come from stock selection. Country allocation effect is minus 3-4%. Industry attribution analysis, similarly, if you see bottom row at the right-hand side, green columns, 26 out of 29% has come from stock selection. These are some of the top names expected to be dominated by the largest names like TSMC, Samsung, and so on. If you look at the contributors year to date, it's similar story. As we all know, Korea and Taiwan have done extraordinarily well, particularly led by Samsung. Now, to generate such strong performance over a long period of time, it's prerequisite, imperative that you have a strong, focused investment culture sustained over time. We call it performance-first culture, which means performance comes first and foremost, and everyone on the team is driven by a single-minded objective to generate the highest alpha or highest performance and hence highest total return compared to anyone else in the peer group for our client portfolios. It's founded upon these 4 pillars: team, philosophy, process, and portfolio construction, which are aligned with one another, meaning it's a stock selection-based philosophy. To go with it, in my biased view, we have the best team in the industry, implementing a time-tested process with a balanced portfolio construction approach when it comes to risk management. So on the team, as I was highlighting, 48-member team with extensive experience of 2 decades, 3 decades, some of them having seen multiple market cycles in developed world as well as in emerging markets, following a very simple philosophy that outsized returns are earned over time by investing in great businesses at attractive valuations. So combination of great business an attractive value. But just because it's simple doesn't mean it's easy. The strength of the team lies in executing this simple philosophy day in, day out, 365 days at its highest level. What we consider as great business is one that has these attributes of superior return on incremental capital, scalable, and well managed, both in execution and governance. And when we find such companies, we invest in them when there's substantial upside to fair value. So buy when there's substantial upside and hold as long as there's enough upside. So we're not from the buy and hold up school, because when there's very little upside, there's no point in holding on. We don't look at PE multiples. We focus on cash flow based approach, first principles based approach, adapted to align with our philosophy in what we call OpCo-FinCo framework, where we split any company that we are evaluating into its two logically distinct components, what we call FinCo and OpCo. FinCo houses the plant and machinery and working capital. From OpCo, to which we assign the revenue and EBITDA, a cost of capital is paid to FinCo, and hence what is left after paying tax in OpCo is the cash flow associated with excess return on invested capital. And present value of such cash flows, which is the present value of OpCo, is the value of excess ROIC in the business, whereas FinCo represents the invested capital or IC in the business. Hence, if you look at the bottom box, enterprise value is the sum total of these two distinct components, which are very logically distinct and very different multiples that you would attach to it. Now, when you rearrange the terms of the first equation and with some mathematical nuances, you get what is the relative multiple that we use, price to excess ROIC multiple. Yeah, instead of PE multiple, we find this to provide more apples to apples comparison rather than PE, which often is apples to lemons comparisons. Investment process, we have a very wide universe that we scout for opportunities. 5,000 plus companies that are more than $300 million market cap, and then narrow it down through those our approach of philosophy and valuation to what goes into the portfolio. Now, the portfolio construction, in brief, if I were to explain, it is basically geared so as to serve dual objectives. It should allow for maximization of stock selection alpha over the long period of time and minimizing the volatility of that alpha. So the numerator is the alpha and the denominator is the square root of alpha, which is basically the information ratio. The idea is to maximize information ratio with a high alpha. Alpha, we believe, all comes from stock selection. Factor risk like country, overweight, underweight, they don't add any alpha. They just add volatility and are zero-sum game over time. So we minimize those factor risks, though we tolerate some factor risk where in doing so, where we believe alpha, stock selection alpha can be enhanced. As an example, the opportunity funnel looks the same everywhere in the world, developed world, including UK, US, elsewhere, and emerging markets where SMID caps are more inefficient. And hence we allocate somewhat higher capital to SMID caps, not because we believe SMID caps would outperform, because there's no logical underpinning to such expectation, but because there's higher alpha potential, we allocate somewhat higher capital to SMID cap and tolerate the risk of short-term underperformance of SMID caps. And similarly, there are other factors. While SMID cap everyone can relate to, because well-established empirical evidence, even though the evidence might not be as obvious, in our experience, we found greater alpha opportunities in what you'll see on the right side of this graph in the green zone, companies with better governance, companies which are lightly regulated and function of business variables rather than macro variables, and more democratic countries have higher alpha potential. So as you saw in the portfolio construction, some of these tend to have higher weights in the portfolio. Now, coming to where the EM valuation is, because EM markets have done well finally over the last 18 months or so after long underperformance compared to the developed world, you'll see that the P multiples on absolute terms on the top left-hand side graph is more or less in line with the benchmark. Even though the market's gone up very rapidly over the last 18 months, the earnings growth has been very strong as well, and it's at about 12 times forward multiple. If on the bottom left-hand side, if you see MSCI World relative to the developed world, it still trades at a very substantial discount compared to longer-term average at 38% discount as of end of May. Price to book tends to be a lagging indicator, so that one shows as having moved up, but earnings growth would, with a lag, reflect in the book as well. If you look at pure price performance over the long period of time, emerging markets versus S&P 500, yes, over the last couple of years, 18 months, you'll see towards the right hand, the curve has moved up somewhat, but it just puts the longer time history puts it in context. that how after a very prolonged period of underperformance starting from 2010, 11 point or some such time, emerging markets for the first time has started to show sustained outperformance. Nothing to say that it would continue or not continue from here. Historically, there have been periods like from 98 to 2011, a 13-year period more or less with some deviation where over a very long period of time, the market has outperformed and other times when over a long period of time, it has underperformed. Finally, to summarize, the trust managed by WhiteOak team, which has a very long track record of very solid alpha generation, consistent alpha generation. We have deployed extensive resources amongst the most well-resourced investment team in the industry with 48 investment professionals who have extensive experience in investing across developed and emerging markets. We have shown to have a strong ability to extract stock selection alpha consistently across market cap spectrum, small, mid, large. We provide in this trust the best-in-class fee structure of zero fixed management fee. We only get paid as a percentage of alpha generated measured over every 3-year period. And we are remunerated in stock, as I was saying earlier. And we also have in place a redemption facility which contains, along with the fee structure and the performance, combined with the redemption facility, has meant that the discount has been very narrow for a lot of time periods. Is actually a premium which has allowed us to do tap issuances.
Is there one investment or group of investments that made a big contribution to returns over the first 6 months of 2026?
So as we all know, it's been an AI-driven rally around the world. In US, in emerging markets, almost everywhere. Stocks can be in any sector, but if they have the remotest exposure to AI, they've tended to do well. In fact, the more remote their exposure to AI, the harder some of them have rallied. So if you look at the absolute return of the EM fund as the trust as well, absolutely, there would be the stocks from Korea and Taiwan and some other places that would have contributed disproportionately to returns over the last 6 months in absolute return terms. So the trust is up something in the mid-20s. A big chunk of that would be from these countries, which same is true for the benchmark as well. In relative terms, that's not necessarily the case. In relative terms, we tend to have, given the way the team manages a balanced portfolio, we tend to have a large number of sources of alpha, both on positive side, contributors as well as detractors. And over any reasonable time period, you'll find that to be the case for funds, not only this trust, but for all funds that are managed by the team.
What is it about your trust that you feel makes it stands out relative to your competitors?
See, any fund or trust would stand out over time only on the back of performance. And when we think of performance, it's a combination of both the magnitude of performance or alpha, as well as the volatility of that alpha, meaning consistency rather. What as a team we strive to deliver as part of what we call performance first culture is to deliver peer group leading performance, peer group leading alpha in a consistent manner over time. And to do so, what differentiates us is not any single component, any single element, but it's a combination of aspects that we believe equip the team to and gives the team confidence to be able to generate alpha over time. We have one of the most well-resourced team, 48 investment professionals who have extensive investing experience in global markets, developed as well as emerging markets, with a strong track record, as data available would show, of generating consistent alpha over time. We have shown to have caliber to extract alpha from inefficient segments, which emerging markets are in general, particularly the mid-cap segments, but we've extracted alpha successfully across market cap spectrum, small cap, large caps, and mid caps. Also important is the construct of the trust. It is, I believe, one of its kind, where there is zero management fee, zero fixed fee. The team gets paid only if it generates alpha, because alpha is true value add. And so the team has put its money where its mouth is. the alpha would be measured over 3-year time periods, and only if over a 3-year period we generate alpha, then net of expenses on that alpha, we would get paid 30% of alpha, and that would be paid in the form of shares of the trust, of which half of them would be locked up for a certain period of time. So there's a strong alignment of interest between the investment team and the investors, and it manifests itself in variety of forms, including the way the fee structure is designed and has been operational since inception.
How are you playing the AI story in the portfolio?
How are you playing the AI story in the portfolio? Certainly, the AI story is playing itself out in different ways in different sectors. Obviously, there's the technology sector, the Korea and Taiwan technology sectors, but also many of the industrial companies. So anything in the food chain has benefited, particularly in industrial sector. Electrical equipment companies have benefited. Companies making any components that go into electrical equipment that goes into power plants or the power grid that then is to facilitate the provision of consistent energy, those all have benefited, and we have in our portfolio companies from across these sectors which have benefited from the sharp rally that we've seen in all things related to AI over the last 6 to 18 months.
Is there anything in the world of politics and economics that's keeping you up at night?
Is anything in the world of politics and economics that keeps you up at night? See, when it comes to geopolitics and macroeconomics, there's always something or the other going on in the world. But we don't get fussed about that. We don't, while it might sound counterintuitive, we don't even try to make alpha out of those, because in our view, these macro top-down developments are just a source of risk. You cannot generate alpha from this in any sustainable or predictable manner. This is a zero-sum game. It introduces, if you try to generate alpha, as many managers do, from these top-down bets, country bets, sector bets, thematic bets, yes, once in a while they'll deliver fantastic alpha as they happen to hit a lucky streak. And likewise, as a mirror image, they would then go through troublesome time period where they'd give back all of that alpha. Over time, alpha derived from top-down or macro bets is purely luck, and over time, such luck is a zero-sum game. Whereas we believe stock selection is the true source of sustainable alpha, and through time, any kind of market cap attribution or sectoral attribution or country attribution of performance has shown our alpha to have come through stock selection, and we remain focused on that. And we do ensure that these macro factors, our portfolio construction is such that portfolio is by and large, can never be precisely, but by and large balanced towards macro risks, geopolitical risks. And once you have a balanced portfolio, you don't need to, there's no reason for you to lose sleep over these. You have to just ensure that you remain balanced to these risks.
The trust has tended to overweight in India since its inception. Is it because you believe there are many great alpha opportunities, or is it you believe the market would outperform?
So as I was saying earlier, we don't believe in alpha generation through picking countries or making macro bets. True alpha generation is through stock selection, and that is the reason why we have tended to have always an overweight in India. It's no different than why we've always had overweight in SMID caps, because SMID caps is an alpha-rich segment of the market. Similarly, India is an alpha-rich segment of the market, which market, emerging markets itself, is alpha-rich in the context of global equity markets. So we've allocated more of the portfolio to alpha-rich segments of market. Now combine that with the way we've constructed our team with 48-member team and growing. We have the resources to extract greater amount of alpha in SMID caps, put the resources, do the due diligence. You can't just expect to generate alpha in SMID caps by putting more money in SMID caps. You know, one can lose their shirt if they don't do the job correctly. And given the strength of resources, given the caliber we have on the team, we have shown over a very long period of time to have extracted strong alpha in SMID caps. Similarly, in India, where there is a large number of SMID cap companies, and we have a special home ground advantage, having invested in Indian market for now several decades professionally and much longer personally. There's a strong home ground advantage, and I've often said investing is a serious form of sport. And I would say, just like in cricket, the English team has a home ground advantage when playing on Leeds or Lords or Manchester or anywhere. An Indian team has home ground advantage in India. Similarly, every investment team might have a home ground advantage in certain countries. We definitely are fortunate to have this advantage in a country like India, which is very alpha rich because of variety of factors, including the large number of mid caps opportunities that are available here.
Well, that brings the Investment Trust Forum for 2026 to a close. I hope you've enjoyed watching everything today. I think we've learned the main message is that wherever you're investing in the world, there are great investment trusts for you to invest in. And the sector is looking good. It's time for an upturn. The upturn's happening. So if you want to keep in touch with the sector and what's going on, do read the news and the analyst reports from the rest of the team at QuotedData. And we look forward to hearing from you and perhaps seeing you next year. In the meantime, thank you very much for watching.
This show was produced by Martin & Co. and is for information purposes only. It is not intended to encourage the reader to deal in any of the securities mentioned in it. QuotedData is a trading name of Martin & Co. Limited, which is authorized and regulated by the FCA. Martin & Co. is not permitted to provide investment advice to individual investors. The show's contents were compiled from publicly available information. The show is not directed at any person in any jurisdiction where, by reason of that person's nationality, residence, or otherwise, the publication or availability of the show is prohibited. Please remember that past performance is not necessarily a guide to the future, and that the value of shares and the income from them can go down as well as up. Exchange rates may also cause the value of underlying overseas investments to go down as well as up. Martin & Co. may publish on companies that use gearing in a number of forms that can increase volatility and, in some cases, to a complete loss of an investment.